CFA Society Nigeria, a member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holder's commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietynG.org for more details. CFA Society Nigeria, making finance a force for good.
Pure Factor Learning Center is a CFA tuition provider in Lagos, Nigeria. We have a wide range of resources that support you to pass your exams. We have a team of qualified tutors with extensive experience in teaching CFA. The main focus at our lecture center is to provide you with the necessary support to make sure you attain your goal. Our unique features include a conducive learning environment, uninterrupted power supply, highly experienced lecturers, easy accessibility, and spacious parking facilities. We offer 2 prep classes, in-person classes and online live classes. For our in-person classes, lectures are solely on weekends. You have 24/7 access to all our tutors. All classes are completed a month to your exams. For our online classes, you have access to our live classes, 24/7 access to our tutors, and access to our online learning management system with recorded videos. Pure Factor Learning. Come to us today and let us make your dreams a reality.
Hello, are you looking for a CFA preparatory school? A tuition to help with your pursuit of the highly prestigious CFA charter? If yes, then First Quartile Professionals is perfect for you. You can join us from any part of the world. We offer online and physical classes. Our pass rate have been higher than the global pass rate in all but one of the last 18 run of classes we have had over the years. At First Quartile, we also adopt a mentoring system to guide candidates through their journey to earn the CFA charter. At First Quartile you get a chance to network with many industry experts. Visit our website or call 0817-607-4526 for further inquiries.
Are you thinking of a CFA prep provider where you can get high quality tuition that will be delivered by some of the very best investment and finance professionals? Think no further, Ivy League is the place for you. At Ivy League, we have a consistent history of delivering and surpassing on our students' expectations across several finance qualifications. At Ivy League, our tutors share a unique characteristic of being very skillful, very passionate, committed, and above all are dedicated to the success of our students. Our CFA lectures holds weekends from 9 a.m. to 6 p.m. on Saturdays and 11 a.m. to 6 p.m. on Sundays. Each class will run for 2 hours with a 15 minutes break in between classes. The classes will be delivered via our virtual learning management system. Why not join us at Ivy League? Simply visit our website on www.ivyleaguenigeria.com/CFA.
Good morning, everyone. Shagun, Chair of Membership,
Yeah,
CFA
good
Society
morning, all.
Nigeria. You have the floor.
All right, good morning, Kemi. Thank you. I've been trying to share my video. I don't know what's happening there. Good morning, all. Welcome to this edition of the Bootcamp. It's a revision class for you guys just to guide you and give you some tips on how best you can approach the exam that can give you some level of chance at passing the exam. So this is what we do. This is for the August edition, and I hope that after this edition, you'll find it useful, you'll find it appropriate, and by the time I see you in the next revision, you'll be joining the revision for the next level. So I wish you guys all the best, and I will also be part of the facilitator, so I'll see you guys in the afternoon as well. Enjoy the class, and yeah, Godspeed, yeah? All right.
Thank you very much, Shagun Jima. Just to add to what the chair for membership, the committee that anchors these boot camp, the message you just passed across. I would also like to make known to candidates present that we, CFA Society Nigeria, as part of our support for candidates in their journey to earning the CFA charter, we have a forum hosted on our website, and you can go on there to register and create study groups so that outside this bootcamp experience, you can take the whatever discussions or whatever issues that are raised here, you can take it up onto that forum and you can network with one another and make your journey easier. Thank you very much. At this point, I would like to introduce the facilitator that will be taking us for the first, and that's Fola. Fola, over to you.
Thanks, Yemi, and welcome everyone to the Level 1 Bootcamp. It's a pleasure to be here, and I trust that you've covered a lot of the syllabus, and this is a stage where you should be doing a lot of revision and a lot of solving of questions, because trust me, it's one of the most important parts of your study journey. And I hope that after this bootcamp, I won't see all of you next year, as you would have advanced to level 2. That being said, I'll be taking derivatives. We have only 1 hour to cover a lot of things, so I'll be skipping through a lot of things, and this is basically more or less a summary. And I want to try and take as much as 15 to 20 minutes to go through questions and, just get us into the scheme of it, of solving questions, reading the questions, and more importantly, understanding the questions, because that's very important. A lot of the challenges people have is because of that exam pressure. They just read through the questions very fast, and they miss the most important part of the questions and miss the question. And it's always a case of, oh, I should have known, but if you had gotten into the spirit of solving questions early enough, I promise you wouldn't have missed a lot of those questions. But anyway, let's start. Let me try and share my screen. So please confirm that you can see my screen. Anyone?
Yeah, I can actually see your screen.
Great.
I can.
Thanks for the feedback. Now, so derivatives level 1. Points are not a lot. It's not as bulky as FRA, but I mean, you could use it to step up your weightings. So these are the LOSs, or this is the LOS. Basically, it's not calculation intensive because this is more of a foundation. So it's just to test the level 1 for derivative, just tests your understanding. Do you understand the background of it? So it's more of an intro. But believe me, as you advance to level 2 and level 3, it becomes more calculation intensive, it becomes more complex. So just relax. This is not where you'll be doing most of the work. It's when you get to level 2 you see the work to be done. So first of all, I take it that everyone, I want to believe that everyone understands what derivatives are and understands the context and has an overview of the derivatives market. The summary of it all is that derivatives are just a contract. So if you were sleeping and somebody wakes you up and asks you, what is a derivative? You just say a derivative is a piece of paper, it's a contract, and it's derived from underlying assets from the spot market. So there's a derivative market, there's a spot market. No one is going to ask you in the exam, what is a derivative? So, but it's good to just understand what it is. The derivatives are like insurance. There are certain nuances that differentiate derivatives from insurance, but they are more or less an insurance because they help to hedge against adverse movements in the assets that you may hold or that you may want to hold. And one last point on this slide is that if you are long a derivative, if you are buying a derivative, you are long. If you are selling, you are short. Or if you want the derivative, if you expect the derivative to go up and you want to take a long position, you want to take a buying position, you are long, and the reverse is for short. I'm going to skip through a lot of these slides. And if you want a copy of the slide, I guess you can contact CFA Society office. I don't know if we're allowed to share, but I'll send it to them. So this is more or less like an overview of the derivatives market, grouped into forward commitments and continuing claims. I'm quite conscious of time, so I'll just breeze through all these types of derivatives. So the major difference between a forward contract and a futures contract is a forward contract is more bespoke. It's traded over the counter, meaning it's traded outside of an exchange. The terms are flexible compared to a futures contract where everything is more standardized. But the major difference between, and that's the key thing you need to remember, the major difference between the futures and the forward market is that the default risk is prevalent in the forward contract because you are doing it outside of an exchange. It's not backed by anybody. But for futures contracts, you are doing it in an exchange. So default risk is assumed to be 0 because even if the counterparty defaults, the exchange has their mechanisms of making sure that the other side of the party is still in the contract and doesn't lose out. We have swaps as well, involves the exchange of cash flows. For instance, a fixed cash flow for a floating cash flow, depending on your situation. You have currency swaps, you have interest rate swaps, different type of swap. I mean, you'll be getting to the details of swaps in level 2. Level 1 is just like a foundation. Options, you have puts and calls, and then you have credit derivatives, with the most common credit derivative being the credit default swap. If you have any questions or comments, you can put it in the chat box, and if time permits, I'll take them. So this is more of a differentiation between futures and forwards. One is exchange traded. The other one is outside of an exchange. They have customized terms. For forwards. For futures, they are standardized. Everybody has to adhere to the terms. So for a put option, let me see if I can enunciate. We know what a put option and a call option is. A call option is an option to buy. Put option is an option to sell. Remember, so this is where people also get confused when I lecture on options. So you are either a buyer or a seller of an option. You are either a buyer or a seller of an option. And there are two types of options. A call option is an option to buy. A put option is an option to sell. Now, for a put option, you can either buy a put option or sell a put option. Because when I explain this to people, they seem to confuse the fact that a put option is an option to sell means that you are selling the option. No, you are buying the right to sell an underlying at a predetermined date. That is for a put. For a call, you are buying the right to buy an underlying asset at an underlying date if you are the buyer of the put. If you are the writer or the seller of the option, of the call or the put option, you have the obligation to deliver or to buy the underlying from the put or the call buyer at the expiration of the call or the put contract. The payoff for a call option is this, and the profit incorporates the price that you paid to buy the call option. Now, in terms of the moneyness just means either the option is in, out, or at the money. The moneyness is excluding the cost of the option. So it's either, so remember that point. If you get a question that says that that gives you the price of the underlying at the expiration date, the exercise price, and gives you the cost of the option, and they ask you if it is in, out, or at the money, please ignore the cost of the option. So you only say if our price of underlying is greater than the exercise price, then the call is in the money. The only time we bring the cost in is when we are talking about the profit to the buyer. Sorry, profit to the call buyer or the profit to the put buyer. Moving on. How do I remove this annotation? I always struggle with this. Clear everything. Oh. Okay, so we have the purposes and benefits of derivatives, risk allocation, information discovery. There are also operational advantages. There are criticisms as well. I'm sure you know of this. The riskiness, high leverage involved, and they could be complex because a lot of times derivatives are used for creation of different strategies. So the last point is arbitrage. So arbitrage opportunities occurs when, you know, assets are mispriced, meaning that if you are able to, I mean, it allows you to take a riskless profit. And the reason why I'm talking about arbitrage is because a lot of the formulas we are going to see in the next, for the next reading is based on the no arbitrage rule, meaning that it's based on the fact that those formulas are created in a way that your profits at the inception is zero. So, and then maybe as time passes, the profits or losses change. So just remember that equations in derivatives are based on the no arbitrage rule. And you will, if you don't understand it now, you would understand it in level 2 when you read the content of the curriculum. So on to the next reading. So we have, I mean, if you've read through the portfolio management syllabus, you would see that, you know, there are different types of investors. Some are risk averse, risk neutral, and risk seeking. I'm not going to go into the definition. What I'm just going to say is that derivatives, in coming up with derivatives and in discounting or coming up with the derivative pricing, we always use the risk-free rate. And that's because derivatives assume risk neutrality. So there is no risk premium when you are valuing your derivatives. Remember, for stocks, when you are coming up with the discount rate to discount your cash flows, remember that you use something called the CAPM, and the CAPM also involves some sort of risk aversion where there is a risk premium. There's a risk-free and you add a risk premium to it. But for derivatives, most of the time, when you are pricing derivatives, you use the risk-free rate. Now, in terms of replication, there's a discussion in the curriculum that talks about replication, meaning I don't want to just go ahead and buy a bond, a treasury bond, which is risk-free. So I can do something called replication. So I can synthetically create a risk-free asset, meaning if I have a long asset, if I'm long and underlying, and I enter into a forward contract to sell the underlying, so I'm short the derivative, meaning I am going to sell the derivative at a predetermined time. Now I'm long the asset, I'm short the derivative. Remember, a forward contract is a commitment, meaning that it's an obligation. You have to sell the asset after the maturity of the forward contract. Now, this combination here is essentially a risk-free asset, meaning you are long a risk-free asset. So a long asset plus a short derivative essentially means you are long a risk-free asset. The reason why I'm highlighting this point is that you may get a question, because the thing is about the curriculum or about CFA these days is they don't ask you the obvious questions. They're not just going to ask you what is an option, what is a call. They're going to ask you an easy question in a tricky way that you start to rack your brain and you start to wonder, oh, either that or you just easily pick an option that you seem very familiar with. But the curriculum could ask a question and say and tell you that based on the principle of replication, if an investor goes long an asset and short a risk-free asset, what has the investor essentially created? And then you get different options: long derivative, short asset, long risk-free assets. So the reason why I'm saying this is based on this first equation here, where you have to think about it. You have to think about the intuition behind it. When you are long an asset, so the first thing when you hear replication in this derivatives context is when you are long an asset and you enter into a forward contract to sell the asset, you effectively hedged yourself. You've eliminated the risk of the price of the asset going down. Why? Because you've locked in a price through the forward contract. Now, you can rearrange this equation, which is this second point here, where you move your long risk asset to the other side. Your long becomes minus long, and in the derivatives world, minus long is short. So this becomes short risk-free asset. So long asset minus long risk-free asset becomes short risk-free asset, and then your short derivative becomes your long derivative. So you rearrange the equation. So whatever they are asking, you can get it from this first equation. Based on replication, what is a short derivative? You rearrange the equation, you move this long asset to this side, and then you get the combination. What is a short risk-free asset? You move this side. So if you understand basic algebra, this should be a walk in the park. Now, we've talked about risk aversion, neutrality, and what's the last one? Risk seeking. So I mean, this is defined in the curriculum, but I mean, I think portfolio management defines it and gives a lot of context to it. So I'm just going to move on to the next slide. Quite conscious of time, so right. So the next point, we're all familiar with the formula, or not the formula for pricing a forward contract. This is the formula, but then it gets more complicated than that when you add the cost and the benefits. So costs could include the cost of storing the underlying assets. Benefits could include dividends. So when you are considering this, you have to take out the benefits, and you have to include the costs. storage cost, insurance, that sort of thing, into the formula. So our net cost of carry is our present value of the benefits minus the present value of the cost. Now, this is confusing because it says net cost of carry, but then we are deducting. But I mean, this is how the curriculum defines it. So if they ask you a question and they say, if the present value of, in fact, let me ask a question. Let me see how interactive we are. And I'm going to wait for an answer. So if we get a question in the curriculum that says, if the present value of the cost is greater than the present value of the benefits, is our net cost of carry negative or positive? Please, can someone quickly answer? So we have a present value of our cost, just looking at the equation, present value of our cost higher than our present value of our benefits. Is it negative or positive? Negative, exactly. So that's the kind of question you get, or they will ask you, if this is greater than this, what happens to our forward price? Is it higher than the spot price or is it lower than the spot price? So that's something you need to take into consideration. You need to remember. Let me see if anyone has asked any question. Negative, negative. Are we referring to the put-call parity equation? No, I haven't touched on the put-call parity equation, but I'm going to touch on it in a few slides. But no, that's not what I was referring to. So we have forward rate agreements, which you would look at in detail in level 2, but basically it allows you to borrow at a locked-in rate. If you, depending on it allows you to borrow or lend at a locked-in rate, depending on where you think interest rates are going to be, and they are based on LIBOR or Euribor or some market rates. But you would see more of this in level 2. So FRAs are forward contracts on interest rates. So an important point which I need to mention as well is when you are engaging a transaction in the futures exchange, you have to, hold on. Right. So for futures contracts, when you are engaging in a transaction, you have to post something called an initial margin. So the long and the short position have to post an initial margin. And there's also something called a maintenance margin. Depending, so your positions are marked to market on a daily basis. Your positions are marked to market on a daily basis, depending on whether you are long or short. Your margin account either declines or increases, depending on if the position goes against you or for you. Now, if your initial margin, if your margin account falls below a level, a threshold, which is called a maintenance margin, if it falls below that level, then you get something called a margin call, meaning that you have to refund your account back to the initial margin level. So that's convention. You have to fund your account back to the initial margin level, not the maintenance margin. And we'll look at a question once I'm done with this. We'll look at a question based on it for better understanding. But for the sake of time, I don't want to stress this. And then for swaps, we talked about the structure of a swap where you exchange cash flows. But the most important point in this slide is that a swap is a series of forward contracts. Why? Because a forward contract has only one transaction day, has only one day where the transaction is done, but a swap is done at multiple periods. So this period is like a forward contract. This period is a series of multiple contracts where cash flows are exchanged. So that point is important to remember. And then what I would just do is I'll look at the relationships between the variables or the some of the variables in pricing an option, and we look at that relationship, whether it's direct or inverse. And I think there's a table here. And then when you have a higher value, when you have the value of a call is directly related to the value of an underlying. So I mean, if you are confused with this, you can just write down the formula for a call. So that ST minus X, when the, let me see if I can just quickly write it down. So you have your ST, so you have that maximum 0 and ST minus X. So what happens? You have to find out, you want to see if there's a direct relationship between a call and the value of the underlying. So you see that as this goes up, the value of the call goes up. So what does that mean? It means there is a direct relationship. Also, for an exercise price, you use this. So in terms of put as well, you put the formula X minus ST, and then you check for the relationship. For exercise price as well, you do the same. And then in terms of time is more of just using your intuition to think about it. In terms of time, there's a direct relationship. Why is there a direct relationship? Because the longer the expiration date of the call, especially if it's an European call or it's actually a European call, the longer the expiration date of the call, the higher the chance of you getting in the money. So you of the call expiring in the money. So there's a wider margin, there's a wider period or wider window for you to do it. So what happens? The value of the call goes up, the price of the call goes up. Now, for European puts, it's a direct/inverse relationship. So when you see a question that's when you see a question that says this, it's either a direct or inverse relationship. And the way to remember this is that you need to think about the fact that put option holders, you are waiting for the sale of the underlying for which you would have to receive the exercise price. So what happens? The longer you have to wait, so by the time you discount this your X back to the present, the T at the bottom, so that your X divided by 1 plus R raised to the power T. The present value of that exercise price, remember you are receiving cash. For calls, you are paying cash, so that does not follow. But for puts, you are supposed to receive cash. So what happens? The present value, because your T is going up, the present value of your X that you are going to receive comes down. Another way to think about it is that you are going to wait for such a long time to receive that X. So that's why there is that inverse relationship. The direct relationship also has to do with the fact that there's a wider window for it to expire in the money. For risk-free rates, it's a direct relationship as well for a call, and that's because for a call you are paying cash. So if the risk-free rate is higher, between the time you bought the call and the time you are waiting for the expiration, you can invest at a higher rate. But for a put, it's inverse. Why? Because you are expected to receive money, so you are losing out on that opportunity cost of higher interest rates. So as the interest rates are going up, the value of your call of your put falls because you are not receiving the cash. And also the present value of the outlay, the present value of the money that you are going to receive has come down as well because of that R, because of this factor. So as this one is going up, the present value of your X comes down. Volatility is a direct relationship, because if there are wild swings, then there's a possibility that your option will expire in the money. Okay, so next slide. Okay. Another important point is the dividends and interest, and also storage costs. So we have to think about, for options, we don't apply the storage cost or dividends to the option value, or the option when we are calculating the option price. We don't include this. And this is and what we then do is then say, okay, when is the best time if we have if we have dividends coming in? If it's an American call, for instance, do we want to exercise our option before dividends come in, or do we want to exercise our option or do we want to exercise after dividends come in? So for instance, if you hold a call option on a stock and the stock is expected to pay dividend tomorrow, what this curriculum is saying is that it is worthwhile for you to exercise the call before the dividend is paid. Why? Because when you exercise the call, you receive the security and then you receive the dividend. But for a put, it is after the dividend that it is worthwhile to exercise, because when you hold it, because for put, you are assumed to hold the stock. When you hold the stock, you receive the dividend, and then you capture the benefits of holding the stock via the dividends. The next point I want to talk about is the minimum value of an option, which is different from the value of an option. The value of an option is the maximum of 0, and S, that's the price of the underlying minus the exercise price. But the minimum value of an option, you have to take into consideration the present value of this exercise price. And for a put as well, you take the present value. So that's just the difference. So when you are looking at the question in the exam, be sure to look at what the question is asking. If they're asking you what is the minimum value of an option, remember you have to consider this present value. You have to consider this present value here. So the lowest value of an European put is the greater of 0, or the present value of the exercise price minus the value of the underlying. So someone was asking about put call parity. So for put call parity, is where you are testing the relationship between a protective put and a fiduciary call. So a protective put, you equate them together. When you have a situation where our protective put is equal to our fiduciary call, a protective put is simply you taking a position in an asset and buying a put in the asset, and you equate this to a fiduciary call, which is the present value of the exercise price that you are going to pay in exercising a call and the price of the call. If this relationship holds, then put call parity exists. If this relationship does not hold, then arbitrage exists. So if our protective put is greater than our fiduciary call, we short the protective put and we buy the fiduciary call. So you can also get the value of a put based on the fiduciary call by just moving parts around. So moving the long put this side, and you can get the value of a long put based on put call parity, moving the value of the call and all that. So binomial valuation of options, I'm just going to be quick on this. So there are different ways of valuing options. You have the Black-Scholes model, which you would see in level 2, and then you have the binomial valuation of options. So this, I mean, there's a whole literature in the curriculum, but everything comes down to the formula where you can get the value of a call based on this formula, and this is a pseudo neutral probability. It's not an actual. So this pi here is not an actual probability. It's more of a pseudo neutral probability, and you will always be given the value. And then this C+1 is the value if the call goes up, or the value of the call if the call comes down. You'll see a lot of this in level 2, but it's just the formula you need to try and remember. So I guess that's it. Let me try and look at some questions. Let's try and look at some of the questions that I got online. Let me see if there are any questions actually. Chat. Okay, we don't have any questions from anybody right now. So let me start from Can you hold on, let me stop share. Just give me 1 minute. Let me share. Please confirm that you can see my screen.
Yes, I can see your screen. There is a question on the chat box, please.
Okay, thanks for that. Please, can you go through the put call parity again? What you could do is, because of time, okay, let me just quickly go through it. Put call parity, it states that for a put call parity to hold, a protective put must be equal to a fiduciary call. And a protective put is the combination of your long stock, long asset, and long put. And a fiduciary call is the combination of the present value of the exercise price and the value of the call, so C0. So you equate those two together. If those two equations are equal, if they are equal, then put call parity holds. So if your protective put minus your fiduciary call is equal to 0, put call parity holds. I think we'll go through a question on this, so that can help us. I hope time permits us. So let me go back to the question, and I'll try and skip as much calculation as possible because of time, or I would go through the answers together below. So the first question, in comparison to underlying spot markets, derivatives tend to be, what do we think the answer is? Based on the need on binomial and Black-Scholes model, is there a need for a financial calculator? Well, you would have to be with your financial calculator when you are there. You have to, I think the CFA has their own type of calculator, so you would have to have it. So you would actually need that, but it's not calculation intensive for level 1. You might see a few calculation questions, but I doubt it will be more than 1 or 2, and it won't be very, very intensive. But when you are doing Black-Scholes model in level 2, you wouldn't really, no one is going to ask you to calculate based on Black-Scholes model. It's just for your understanding. So everyone is choosing C for number 98. Offers easier access, yes, to leverage and short position. So let's go to the next question. So 90-day LIBOR is this. 180-day LIBOR is this. The forward rate that a borrower would, I think this is level 2 material. I don't think the curriculum talks about it in detail. But so I think this is more of level 2 material. So I'm not really going to bother myself about this. Now, the next question, BWC Chemicals is the fixed rate payer on a plain vanilla swap. Since the swap commencement, interest rates have fallen considerably. Which of the following statements is accurate? So you are the payer. You make the payment of the fixed rates. Remember, fixed floating swap. there's either a fixed rate payer and a floating rate payer. So you are paying the fixed rate payer and you are receiving the floating rate. So what they are saying is interest rates in the market have fallen considerably. So you are receiving so imagine if the fixed rate is 4% and then the floating rate has fallen to 1%. So you are paying 4% and you are receiving 1%, which is a lower interest rate because interest rates have fallen, which is the floating rate which your swap is based on, which you would receive. So what we are saying is, which of the following statements is true? What do we think the answer is? C. So the present value of the floating rate payments will be lower than the present value of the fixed rate payment, meaning that you are going to pay more than, so it's just intuition. You think about what am I paying and what am I receiving? The price of an underlying security is 520. A put option with an exercise price is 528 and has a premium of 0.08. So let's look at it. It's a put option. Our exercise price is 5.28. It's greater than our underlying price. Is it put in the money, at the money, or out of the money? I'm getting mixed answers. Okay, I've seen one correct answer. Okay, yeah. So it's not out of the money and it's not at the money. Why is that? Because when you are looking at a put, if the exercise price is greater than the underlying price, then the option is in the money. We are ignoring the premium. It is only when we are looking at the profits to the buyer, that is when we include the premium. So we are saying our exercise price here is greater than our spot price. So the answer is in the money. The next question, which of the following is most accurate? The lowest, not the value, the lowest value of a European put option is the greater of. So we've talked about this. What's the answer for 102? I need my geniuses to answer. 102, what do we think the answer is? C, 0 and the present value of the exercise price less the spot price. Thank you very much. So there's a difference between the minimum value of a put option or a call option and the value of an option. And if you don't understand why this is the case, there's a literature in the curriculum that explains that using some sort of proof to, or using some sort of literature, they use some sort of arguments to come up with this equation. So let's think about this question. So this is more thought-provoking, the question 103. The early exercise price for, oops, what did I do? I've showed the answer. Okay, let's look at 103. I showed the answer, so I don't know if when you answer me to be genuine or not. Early exercise of an American option immediately before the dividend would most likely be warranted. Let's think about it. So it says A for a stock call option. So let's think about it. Early exercise. So you want to exercise early, an American option. Remember, an American option you can exercise anytime. A European option you have to wait till maturity to exercise. So you can exercise anytime, and they're saying if the dividend is going to be paid tomorrow, if the dividend is going to be paid, is it worthwhile to exercise? And they're saying yes. For a stock call option, yes, it is worthwhile to exercise. You know why? Because a call option is an option to buy. So when you exercise the call option, what do? You pay cash. You receive the underlying. You now own the underlying, which means you are entitled to what? You're entitled to dividends. So that's why they are saying A is the correct answer. You have to think about it. You also have to think about the fact that if it was a put, remember for a put, you own the underlying. When you exercise, you sell the underlying and you receive cash. So when dividend is paid after you exercise, what happens? You lose out on the dividend. So what they are saying for puts, it is not worthwhile. Early exercise is not worthwhile. Why? Because, and that's for American put, because if you exercise early, you would miss out on the dividend payment. But if you exercise later, you would capture dividend benefits. Right, so we are done with this. Let's go to the next one. So I think I downloaded these questions online, and I hope they are still relevant. But I think they are still relevant. Okay, so now this is what I wanted to explain, because this is and this kind of drives home my point on reading the questions. So what they are saying is this. This person sells 4,000 equity index futures contracts at 224. Now you provide an initial margin. So what happens? Remember what I said? You provide an initial margin of 20 euros per contract. Now what they're saying is that when you get a margin call, when your margin falls below the maintenance margin, which is 12 euros, in the event of this margin call, additional margin has to be contributed up to the maintenance margin level. Now, this conflicts the convention. The convention, or in practice, you have to refund your account back to the initial margin. But now that's why I said you need to read the question, because this is maybe a special exchange. And what they're saying is our rules are different here. And in this case, you only have to bring back your margin back to the maintenance margin level. So what do we do? What they're asking for is, what is the margin account at the end of day 3? So let's look at it. You are short the forward contract. What happens? On day 1, because you are short, you want the price to go down. If the price goes down, your margin goes up. So what happens? On day 1, the price goes up by 14. So what happens? Your margin has, the amount of your margin is plus 14. So that is equal to, so you have your 20 plus 14, the amount in your margin, sorry, the amount in your margin actually goes down. Sorry about that. Margin in your account goes down. So the amount in your margin now is this 14 or 10? Okay, 10. 234 minus 224. So the margin, the amount in your margin account goes down to 10. The next day, our price falls from 234 to 248. Sorry, increases from 234 to 238. But because we are short, our margin account comes down. So what happens? So, sorry, I made a mistake. Let me start all over again. Let me quickly start all over again. The amount in your margin account is 20. The price falls down. The price increases by 10. But because you are short, the amount in your margin account falls down to 10. So now, at this point, your margin account is below the maintenance margin. So what are you required to do? How much are you required to bring back up? Because they said you have to bring back an amount back to the maintenance margin, you bring back your account to 12. So your account goes back to 12. This is day 1. Day 2, the price increases by 14. So what do you have? Your maintenance margin is 12. It falls by 14. The amount in your margin is now minus 2. So let me ask a question. When you get a margin call again, how much are you bringing back? Let me ask, can anybody help? So you are bringing back 14. Great. So you are bringing back 14. So now your account is back to 14. The third day, you are in the money, or the price goes in your favor. So what happens? The price falls by 18. So your margin account increases by 230 minus 240. I feel like I've made a mistake somewhere. But anyway, so your account increases to 32. So what they're saying is, based on this information, the balance in Farrell's margin account is what? So it's supposed to be 32 times 4,000. I feel like I've made a mistake somewhere, but let's see what the answer is. So the answer should be C, but I made a mistake somewhere. So let me just scroll down. So the answer is C. Okay, I made a mistake in the additions and subtractions somewhere. I'm not sure, but I just want us to get the gist of it. So what happens is, at the end of day 3, your account falls by, the futures has fallen by 18, meaning that your account that was 14, sorry, so when you added this 14, your account came back to 12. Remember, so 12 plus 18 is 30, and what happens? Your account is 30. So I just want us to get the gist of it. Clear all drawings. Let's move to the next one. Which of the following is least correct? 101. Which of the following is least correct? A credit default swap is what? What do we think the answer is? What do we think the answer is? What is a credit card is not? Something that a credit card is not. Is it not? So which of them is correct? Oh, thanks. Someone was correcting me here. So thank you. So a credit default swap is not a forward commitment. It is either a credit derivative and it is also a contingent claim. Next question. Which of the following is least likely to be the reason for an arbitrage opportunity to remain unexploited? What do you think the answer to 102 is? What do we think the answer to 102 is? Someone said A. Any other takers? Someone says B. Someone says C. So A and B are incorrect. C is correct. The reason why C is correct is that we are asking the least likely reason for an arbitrage opportunity to remain unexploited. So if there are significant transaction costs, we won't exploit arbitrage opportunity. If there is difficulty in entering short position, we won't. But ethical objections, there's nothing unethical in taking advantage of arbitrage because they are bringing back equilibrium. So it's not unethical. So there's nothing about ethical objections as a disadvantage of mispricing. If anything, you're actually doing the market a favor by actually taking advantage of arbitrage so that you are bringing the market back to equilibrium. Right, so this is a calculation question, and I'm not going to go into it, but it's a forward position. You are valuing a forward position on an equity forward contract. So what do we have? We have the formula here, value. So you have your ST minus the forward divided by this, and then you get your, you can go through it later on if you want. Now, I think this is the last question. Let me see. Okay, so you have a company that has entered into, I think this question is going to take a lot of time, but I'll try. A company has entered into a 40 million 3-year debt on which it pays a fixed interest of 7.6. So now the company expects interest rates to drop over the coming years. What happens? The company enters into, if you expect interest rates to drop, you want to receive the higher rates. So what do? You lock in a high rate, the high rate environment, you lock in what the rate is now. So you enter a swap contract where you are receiving this 4% because you expect interest rates to fall. You are going to get a fixed rate of 4% and you expect interest rates to fall below 4%. And the floating rate is LIBOR plus 1.8. The notional value is 40 million and is based on 60 day year. So what we are saying is the LIBOR is 1.3% on day 360. Which of the following statements is least correct? So let's think about it. The first thing is that the interest rates have come down. So your LIBOR is, so the LIBOR rate is LIBOR plus 1.8. So your total rate that you would remember, you are receiving 4% and you are paying this amount. You are paying this. So your LIBOR plus 1.8 is, where is it? 1.3 plus 1.8, which is, I think it's 3.2. So you are going to be paying 3.2 and receiving 4%. So what they are asking is which is least correct. The first one is saying the 90-day LIBOR rate on day 360 corresponds with a swap payment of, I don't know if this is true or not. I have to calculate it, and I'm not going to calculate it because of time. The second one is saying, we are saying which one is least correct. It's saying that the swap payment will be made on day 450. Remember, someone is saying 3.1. Oh, yeah, 3.1. So 1.8 plus 1.3 is 3.1. Sorry. So the swap payments will be made on day 450. You are on day 360. What happens with swaps? And if you read the curriculum, and you see a lot of it in level 2, I doubt you will get this kind of question in the exam. But if you read the curriculum, for swaps, the payment is not made on the day that the LIBOR rate discovery is made. The payment is made within the next period. So either within the next quarter, that's when the payment is made. So we're on day 360 and the payment is made on day 450. Okay, someone is telling me to round off. Okay, and then the next one is the payment will be made to company XYZ. Why would the payment be made to company XYZ? Because company XYZ is receiving the higher payments. Someone is taking a walk in the park and enjoying nature there. Okay, so you receive the higher payments, which is company XYZ receives the higher payment. So the net payment goes to company XYZ. And so B and C are correct, which means B and C are wrong because we're asking for the least correct. And A seems like the answer because A seems like the least likely correct. So it's been calculated and the payment you are getting is 90. So A is the correct answer here. I'm sorry if I haven't been able to, if there are still questions or people are still confused. For the sake of time, we can't really go through a lot. Yeah, so the next question is just fitting your figures into the formula for binomial model. So this is the calculation here. And I think we're done. So for those of you that had issues with the put call parity, please go through the curriculum or go through Schweizer if you have the notes. It's very self-explanatory and it's easy to comprehend. I wish you the best of luck in your exams. And like I said, I hope I would not see any of you next year's bootcamp as you would have advanced, or I hope to see all of you in the level 2 bootcamp next period. So good luck and thank you.
Thank you very much, Fola, for the insightful lecture on derivatives that you just delivered. I believe we have Muhammad Boba to anchor the next session, which is going to be on alternative investments. Muhammad?
Yeah, hello.
Hi.
Hello, good morning all.
Good morning. You're welcome.
Thank you. Yeah, thank you, Yemi, for the brief introduction, and thank you, Fola, for the insightful derivative lecture. My name is Muhammad Buba, has been introduced. I'll be taking you through alternative investment in the next 1 hour. So, and share my screen now. Okay, can you all see my screen?
Yes, it's coming on. Yes, Mohammed, I can see your screen. Would you want to put it on full screen to make it more legible?
Okay. It's better like this?
Yes, this is good.
Okay, thank you. I think we'll start with, I'll do it in my own way. We'll start with questions so that because I believe the essence of the bootcamp is for us to revisit what we've done and trying to test our knowledge and also revisit certain issues. So I will start with a question on fees and returns, which is this. So I'll give you 3 to 4 minutes for the candidates to attempt, then we'll discuss the answer. So the clock starts ticking now. Thank you. So I can get your answers on the chat. Yeah, we still have a few minutes. No answer yet. Okay, Abayomi has entered an answer. Let's have more. Try to attempt, that's the essence of the bootcamp. Don't worry, even if you don't get it, that's why we're here. Let's have more answers. One more minute to go. Give it a try. You can do it. Can we have another one? Good. Respect more. Yeah, I can see more answers now. Good. Okay, I think I will have to solve it. Okay, so now in this kind of questions, I can see from the answers, I can see where the pitfall is coming from. So what you do first is you start with the management fee. You look at the rules. It's 220. It's independent fee structure. It's also a soft hurdle. Then you have what we call a high watermark, right? So what you do first is, okay, what you do first is for year one, you simply get the management fee, which is 2% of 140 million, which I suppose that will give you 2.8. Then incentive fee, have we crossed? You look at it, is 20%. The hurdle rate is 5%, and it's a soft hurdle. So since it's a soft hurdle, you give the entire return. So you have 40 times 0.2. That gives you 8 million. So you have a total fee of what? 10.8 million. Then you need to have what we call the ending value of the return, the ending value of the investment, which is now 140 minus 10.8. That will give you, I believe, 129.2 million. So this is the value for year one. Then for year two, you're starting with 129.2 million, while the investment went up to what? 90 million. So because fees, management fees at the end, so you give 90 million by 0.02, you get a figure, right? Then there's no incentive fee because the investment had a loss. So you have a management fee of 2% on 90 million, which is 1.8. So the ending value becomes 90 minus 1.8 million, which gives you 88.2. This becomes the ending value for year two. So why in year three? Year three, we have an investment that went up to what? 160 million from what? 88.2. So you have a management fee, of course, 0.02. It gives you 3.2 million. An incentive fee, and this is where the trick comes. Because we have a high watermark, and the highest achievement for this investment is already 129.2 million. So if you're going to pay incentive fee, it's going to be simply 160 minus 129.2 million. .2. So you have So you have 6.16 incentive fee. Then you have a management fee of what? 3.2. Right? So this is our management fee for management fee. This is our incentive fee, 6.16. And the return simply is the total fee, which is 6.16 8.2 plus 3.2 deducted from the entire amount. So you have 9.36. So when you want to calculate return, you start with 160 minus what was the value of the fund? It's 8.2 minus 9.36 divided by what was the value? It's 8.2 times 100. It will certainly give you 70%. So I saw most of the people giving me B, and I understand the pitfall was you using 180 minus 88.2, 160 minus 88.2 to calculate the incentive fee instead of using the high watermark of 129.2. So I believe this clarifies, and when next you see this kind of questions, you just take care of the pitfalls. For those who got C, thank you very much. Congratulations. For those who got B as well, it's a good try, and it shows that you actually understand the cost, but you now learn from the pitfalls. So the pitfalls is the high watermark, and we learn from that. So the next question here is for us to be able to calculate what's called the catch-up clause. So I'll give you 2 minutes as well. Okay, we're getting some answers already. That's good. Let's try. That's the essence of the bootcamp. Well done, guys. Okay, somebody's changing his mind. Okay. Okay, we don't have more options, more answers, please. I want it to be engaging. I want people to put their answers. I want you to be active in the session, not just waiting for my answers. With that, you'll be able to learn. Okay, we have another answer. I'll just wait for a few more, then we'll go solving it. Okay, somebody even give us both answers for the both questions. Yeah, if you can, you just answer both questions. It's easier. Okay, because of time, I'll just go straight to it. So this is the concept of catch-up. Catch-up is trying to ensure that the 80-20 principle remains. So in this case, we have a hard hurdle. We have a hard hurdle rate of 10%, and the investment rose from 100 million to 120. So 10% is 110. So it means we've gotten the hard hurdle. So in this case, the first thing, if there's a catch-up, you have to ensure that the LP gets the entire 10%. So 10% out of the 20 goes to the LP. Then for you to catch up, you assume that this is an 80-20 principle. And for that reason, as long as the LP has gotten 10%, this is assumed to be an 80% of the profit or the return. So in that case, for you to get, for the GP, you want to catch up to ensure he gets 20%. you need to look for the 20% of this 80% profit. So you need to get the 100% first. How you do that is a simple calculation of 10 divided by 80%. You get the 100% value. Then you multiply by 0.2. And that will give you his own share, which is 2.5. So I haven't gotten this. The next thing is LP gets 10%. GP catch up with what? 2.5%. Out of what? Out of the 20%. What is left is what? 7.5%. Then you now share this 80, 20. LP gets 80, GP gets 20. So 20% of this will give you 1.5. So the total fee for the GP is now 2.5 plus 1.5, and that gives you 4%. So B becomes the answer. So that's it. So for the catch-up, it's just simple. Whatever its guaranteed hurdle rate, you divide it by 0.8 to make it up to 100%, then you take 20% for the GP. That's your catching up, ensuring that the 80-20 principle holds. Because if you don't do that, if you do a hard hurdle straight, you're saying the LP gets 10%, then the remaining 10% is shared between the LP and the GP. And in that case, you have 8 and you have 2. So the GP ends up just getting 2% instead of 4%. So I believe that makes it clear. So for the next question, we said the Bootcamp hedge fund introduced a 2 clause in the LLP structure. And the clause is simply saying that GP is not paid twice for same performance. And once the GP receives a return exceeding the agreed 80-20 ratio at liquidation, he must refund the excess. So this is simply giving us the terminology of the clause. You need to make sure they are very handy because you might have questions like this during the exams. So what a high water mark does is simply saying that if you have a return at 100 here, if it moves to 120, you're going to pay him incentive fee here. If he brings the fund back to 80, he gets no incentive fee. If he moves it back to 100, you also don't give him an incentive fee because your investment was once at 100. And even if he moves it to 120, he doesn't get an incentive fee because your return was once, your value of investment was once at 120. He only gets incentive fee when you cross this. So when you get above 120. So this, not paying him at this is ensuring that he doesn't get a return, he doesn't get paid for the same performance. He has already moved the fund from 100 to 120, unless he makes a better performance of moving from 100 and above 120. That's when he deserves a performance fee. So that's what we call a high watermark. So clawback provision is saying if I start my fund at 100 and after year 1 is 120 and after year 2 is 100 and I pay an incentive fee here and the funds closed at 100. So it means in the ideal sense, there was supposed to be no incentive fee because we liquidated the investment at the initial value we started. So if he had earned 20 here or 2% here, he is going to return it back to the LP. So that is what we call a clawback provision. So in this case, the answer is also B. So I believe we're together. If we are, just send a message on the chat box for me to know we're together. Okay, good, Faith. So the next one is for us to go into, okay, these are also questions, question 4, question 5. This should not take you more than 1.5 minutes. One minute for this. Number 4, what's the answer? Number 4 and 5. Okay, what this is just saying is a distribution waterfall is just how you share the profit and how you calculate the returns. So you have two types. You have deal by deal and whole of funds. The deal by deal is trying to say for each deal, you're going to treat the management fee and incentive fee deal by deal basis. In that case, you're not going to net. So if I have an investment of 100 here and it becomes 110, I have another investment 100 and it becomes 90. On a deal by deal basis, I'm going to earn a fee here, no fee. But on a whole fund, I'm going to look at the net. It's 200 investment and there was a loss, so no incentive fee. So this whole funds, it's more favoring to who? The LP, because they don't get punished for a deal by deal case. But and another name for this deal by deal is American. Another name for whole of funds, it's European. So the deal by deal favors the GP, while the whole of funds favors who? The LP. So in this case, we're looking at what favors the LP is also an European waterfall, and what favors the GP is American waterfall. I see most of you saying C, C is not C. Number 5 is the management fees are charged before capital are invested. On a private equity scheme, before capital are invested, you charge fee based on what we call committed capital, because you don't want the private equity firm to be requesting for funds when they don't have viable investment. And also, an arrangement that is made with just few LPs is written under what? In a side letter. So B is also the answer here. While for hedge fund, management fees are charged with assets under management. So I think that clarifies it. So maybe you need to revisit the curriculum to understand deal by deal is also the American waterfall and it favors the GP because it's deal by deal is irrespective of the whole fund, while whole fund is European waterfall, which favors the LPs. While committed capital is used to charge management fee for private equity, while asset under management used for hedge fund. Okay, the next thing is for us to go into what alternative investment is. Alternative investment simply is any other investment other than cash, bonds, and stocks. So this is alternative investment. So, and we have it, hedge funds, private capital, real assets, private debt, private equity, which we're going to be discussing in more details. So what you just need to know, because we're not going to have time to discuss all this concept, I'm just going to be highlighting the most important things. What you need to know about alternative investment is that they allow you to take long and short positions, while traditional investments are long only. They are more active. They use more of leverage. They have restriction of funds. That's why they are very liquid. If you give your money to the GP, you have to wait for some time, which is called the lockup period. And if you want your money, you need to give them a notice, which is the notice period. They also have biases such as survivorship and backfill. Survivorship is saying that alternative managers are allowed to form an index, but they are not obliged to give out information. So they decide what they report. In that case, they only report surviving hedge funds. My backfill is you join an index today, but you're reporting your previous performance into the new index. So these are characteristics of alternative investments. They are illiquid. You need specialty. You need certain managers to invest in that. So you need to look for the kind of managers that will invest. There's narrow manager specialization, low correlation with traditional investment. It means once they have a look, if traditional investments are going up, alternative investment might be down. So this gives you what we call diversification. Also low level of regulation and less transparent because they are for people, high net worth investors, so they're not regulated by institutions. So they also have problem with their data. They use appraisal values, which risks are understated, and also they have an overstated risk-adjusted return, which is the Sharpe ratio. So on a portfolio context, if you want to invest in alternative investment, you need to know it gives you high return, diversification benefits, high Sharpe ratio, and also allow you to earn alpha from diverse investment. Alpha is simply above beta, right? It's just trying to say when you beat the market, that's an alpha return. Why the beta is the market return. So within a portfolio, if you are a liquidity concerned investor, you should know that alternative investment is illiquid. You have to look at also your risk objective. Alternative investment is highly risky. Are you also a high net investor or you're a retail investor? For risk measure, one thing you need to know it's important is that standard deviations are not suitable for alternative investment because they have more fat tails. So the best measure is Sortino ratio, which helps take care of both upside and downside risk. So let's have some questions, 1 minute. They're simple questions. So number 6 is what, and number 7 is what? Okay, just like I said earlier, good, I can see the answers. You guys are spot on, keep them coming. Yeah, good, spot on, very good. So this is the concept you need to be very careful when you're doing questions in the CFA. Things like this, least likely, most likely. So traditionally, alternative investment are least likely to be characterized by what? They are not going to have this feature we want. So they're not going to have what? High regulation, right? They have high leverage, they have high fees. What they don't have is regulation. So please take note of that. Then the next one here is alternative investors are most likely to have what? Are they transparent? Do they have redemptions and restrictions on funds? Are they liquid? We've talked about the fact that they are not regulated and they are not transparent, and also they are not liquid. So, but they have what we call lockup and notice period, which are restrictions on redemptions. So those are the answers. What of this? Number 8 and 9. Okay, I can see the answers coming. Yeah, interesting answers coming. Interesting. Some of the answers are interesting, and I can understand. Okay, because of time, I will just answer them. Yeah, then you can verify with what you have put or what you intend to. This is not a category of alternative investment. The answer is B, is timberland, because the new, if you look at the new curriculum, private. If you look at the new curriculum, private capital is now taking care of private equity and private debt. So this is a category now on its own. Timberland falls under natural resources category, while hedge fund is a category on its own. So the answer is actually B. Then this potential benefits of allocating a portion of portfolio to alternative investment is B. I talked about risk adjusted return, right? You have less risk because of the understated standard deviation. So you have an overstated Sharpe ratio, and also it gives you diversification benefits. So this is in a portfolio context, it improves your portfolio risk and return. Ease of manager is not easy for you to get managers for private and for alternative investment because you need managers with certain skills. Accessible and reliable measures, I've talked about it. You don't have reliable data and the risk measures are not correct because we use standard deviations most often. So the next thing is the forms of investment in alternative investments. So we have 3 broad forms. The first one is fund investing, which impliedly we've been talking about. It's just simply saying you have an LP. It's just simply saying you have an LP and they give money to a fund, and the fund invests in either hedge fund or private equity. So that's a fund investment. So in this case, you are investing in a fund, which is this, right? And the managers, who are the GPs, take different investments and you share profits or you share returns. And you also pay them fees, just like we've explained with the management fee and the incentive fee. So that's simply a fund investment. So if you look at this kind of investment, it's more suitable for people who don't have expertise. You don't want to take, you don't have the knowledge to look for these investments. then you go through this fund and they do all that, and you pay them a management fee and a performance fee. While co-investing is simply an investor that is a bit sophisticated. He has knowledge on how to source this investment, but also he wants to go through a general partner. So what he does is he co-invests. He invests in the GP's fund, one, then also he invests in this investment directly. But in this case, he uses the advice and expertise of the GP. So most of his investments will be based on sourcing from who? From this GP. So he is in his fund, and also he uses him to invest directly in portfolio companies. While the third one is the most sophisticated investor who doesn't need any advice from anybody. He's so good, he goes direct and invests. So these are the three forms of investments. So see what they do. You contribute to a pool of funds, you pay fees, you need less money because you can have access to this because they don't require huge minimum capital compared to the other two, right? So your due diligence is less because you're using the manager, and it's suitable for less sophisticated investor. Here is the medium one. You contribute and also invest directly. You also have less control. You have some level of control, but here you don't have any control. Why here you have direct investment, greater flexibility and control. The capital required is high. You also don't pay fees. Why here you pay the highest fees? You pay medium fees here because you use the fund. Then you need a lot of due diligence here because you're investing directly. So let's try questions on this. Number 10, 11. Okay, number 10 is good. C is the answer. For 10, you have direct and indirect approach, yeah. Number 11. Okay, number 11 is also direct investing because you require a lot of what? A lot of due diligence. Then number 12 is fund investing, which is A. Okay, good. You guys are just killing it. I can see the answer is CCA. You guys are doing a good job. Let's keep it up. Okay, so let's make progress. If you have questions or I'm too fast or anything, just put it on the chat. And if we're going together, you're fine. You also let me know so that I can gauge how I go. So thank you for the answers. You guys are doing well. So the next thing is for us to talk about alternative hedge fund. I think we've started talking about this. I'll only pinpoint some of the most important things that you need to know. Here, you just need to know that the benefits for a hedge fund is you get high return, there's diversification benefits, and also they can invest in anything they want and they can earn an alpha return. Their beta can also be zero. They can hedge the market completely. So they have lockup and notice period. I've talked about that. They use a limited partnership structure. Investors that will invest in this must be qualified investors, high net worth individuals. So the concept here that we need to add is what we call the FOF, funds of funds. So what they do is they allow LPs who have retail LPs, investors who are not as rich as myself, to have access to hedge fund, because these hedge funds here require qualified investors who must have a lot of money. So we call it what we call the rich people mutual fund. So if you're not rich and you want to have access to these guys, you can come through the FOF. So the FOF receives your money, then invest in hedge funds. So they can also invest in different hedge funds. So here they give you diversification benefits. They give you access to invest in hedge fund with a small amount of money. And also you don't require due diligence because they do the due diligence to get the hedge fund. So the benefit is diversification, easy access, favorable redemption terms. Because they have a lot of money received from different LPs, they can negotiate better terms than yourself. But the only disadvantage is this: you pay them a fee and they also pay a fee here. So you have double layer of fees. No question will make progress. Thank you. The next thing we need to know about hedge fund is the strategies. Also here, I'll just give you the high level point, what you need to know. For event-driven strategy, always look at events at company level. It is also bottom up. You're looking at what is happening in the company level. Are they mergers? Are they activist shareholder? Are they spin situations? Are they spinning out or divesting? Or is there an investor who is trying to buy a public company, trying to buy most of the shares and impact a certain decision? What is happening at that company level? So are they restructuring? So anything you see at a company level is an event-driven strategy. That's what you need to know. Relative value, the keyword is arbitrage. If similar securities are mispriced, if you see arbitrage or you see any word mispriced, just know we're talking about what? Relative value arbitrage. Relative value strategy. So the next one is macro global. What you need to look at for is broad. It's a broader term. You're looking at macroeconomic variables. You're investing in the entire country or currency, but at a broader level, not company, right? Equity is all the strategies within an equity. You're looking for a company that is going to grow. You're looking for a company that is not doing well or is overvalued. You want to take a short position, that's short bias. You're looking at a company that has fundamental value, that means it's undervalued. This is also bottom up because you're looking at stocks and at a company level. This is top up because you're looking at the entire broader index, whether you're talking of the S&P 500 or you're talking about an entire country. So here you're looking at mispricing, like if you have oil sold in Nigeria, 150, in Niger is 90, there's arbitrage values. So this same oil but sold at different prices. So anything that you see here, it's all reflecting to these key terms. We've talked about this already. We've done the calculation to make it clear. So let's have questions on hedge fund. So the first two. Okay. Okay, the first one. Okay, let me have more answers. You guys are doing well. Let's keep it up. Okay, for the first one, like I said, for a relative value, the keyword to search for is what? Arbitrage, right? Or mispricing, right? And as you can see here, relative value, convertible arbitrage. So C is the answer. For this, it's an equity hedge fund strategy that focuses on what? Overvalued securities, best described as what? Okay, we have C, we have A, we have A, we have A, we have A. The A are becoming more and more. Okay, all right, so let me clarify. The answer is actually C. And when you're talking about short bias means you're taking more short positions. And short positions is simply selling, right? You only sell a stock when you feel it's what? Overvalued. For fundamental value, anytime you see fundamental value, anytime you see value, it means you're looking at the fundamentals of that company and you feel it is what? Undervalued. Because we are always long bias value, right? So unless otherwise, unless clearly stated overvalued, it's always long bias for value strategy, right? So it's actually short bias. I don't know if that helps because most people went for A. So A is long bias value, but this we are talking about overvalued. And when you overvalue, when a stock is overvalued, the next thing you want to do is you want to sell it. You want to take a short position. Okay, thank you. Okay, let's look at this. So now we have A hedge fund that employs fundamental growth strategy using equity is most likely to seek out shares of company that are what? Okay, this is also tricky. And I can see that from the answers. Okay, so this is actually C because this is actually C because we are talking about growth strategy, fundamental growth. You're saying that the companies have a potential to grow. While on this one, what does hedge fund does to a portfolio? Like I told you, they give you higher return. And also because they have less correlation with traditional stock, they also give you diversification benefits, and that reduce your portfolio variance, right? So the answer is actually C here too. So private capital. So for private capital, we're going to be looking at private equity and private debt. Because of time, I'll just skip through the most important things. So what you need to know is we have a leveraged buyout, we have venture capital, we have development growth capital. Here, leveraged buyout is simply you're buying out a company, you get a public company, you buy most of it through debts. That's why it's leveraged buyout. You make it public, you make it private, then you get it better, then you go public again. So for private equity strategies, you are always thinking of what? An exit. There should always be an exit strategy. So for leveraged buyout, is always for matured companies, either they are public or they are not public, but they are very matured. They have their price stock is down. That's for a public company. They have a lot of assets because you're borrowing, you need collateral. They have cash flow, you want to be able to pay. They are inefficiently managed because you get them better managed, then you sell them at a higher value. So that's for LBO. MBO is when you are the one, the managers in that company are still being retained, while MBI is when you're bringing in new managers. Venture capital, what you just need to know is the stages. It's when you invest in a startup. So you have angel investors, seed, and early investors. This is the formative stage. For angel investors, it's your friends and families. This is your friends and families. This is when the VC starts to come in, and this is when you start commercial production. This is when you now have a product developed, right? This is when you just have an idea. So the later stage is when you are expanding. Mezzanine is when you are preparing for what we call an IPO, right? Okay. What are the attractive targets for VC? You look for companies that have high potential. And for every 100 VC, most times just 1 or 2 succeeds. But when they do, the return is very huge, right? So growth capital is simply you get a company and you just get a minority stake in that company. So the benefits for private equity is high return, little diversification because they behave like public companies. It's illiquid. Access to top quartile manager is very important because the difference between the top quartile manager and the one that is not top quartile is so huge. It uses, I've talked about committed capital and invested capital. These are just valuation. You do this more in level 2. Yeah, so private debt is simply, are you lending directly? Or directly is when you're borrowing money to a private company, right? And they give you a fixed interest. It's not tradable, so it's highly illiquid. And so you have a premium. So, and the yield is also high. You have senior and secured. They tranche it that way. Mezzanine is when you want to give funds to a private company that is close to going public. So they give you a higher yield, and also they have what we call convertibility feature. This convertibility feature allows them to also convert their debt to equity when you finally go public. Venture debt is also when you borrow a venture capital, but it has a venture backup. That means it is already in the seed stage. A venture capital has already joined, right? Suitable for startup going to public. Distressed debt is when you get the debt of a public company that is really in distress because of issues and fear. You buy it because you know they have a lot of assets and you can make it better, you restructure it, then you sell it at a higher value. Collateralized loan, this you do more in fixed income, is just asset-backed securities where private debt firms pull up different loans and they issue security and use those loans as asset-backed. So we don't have time. So let's have questions on this. Yes, I'll give you the slides. I'll give you the slides because of time. So with respect to venture capital, the time as a 9 is what? Okay, Good. You guys are getting it from preparing you for public. Yeah, then the other one, formative stage. What stage is this? Yeah, it's the SIP stage. Good. The last one, don't worry, just put in your answers. I'll be looking at them. Okay, number 3. Okay, here I'm going to clarify. This is the answer. Trade sale is when you sell to a competitor, right? Like Facebook buying Instagram and WhatsApp. So that's trade sale. This other one is what we call secondary sale. A private equity selling to another private equity. Okay, so that's clarified. Thank you. What of this? Okay, so this is both. They both have convertibility feature. This has, because this is backed by assets, and this is also senior. Why mezzanine is always lower than the senior rank. So time, and we have a lot to cover. So for commodity, I think what you just need to take in is what drives returns for commodity, and simply is what price changes and not income streams, right? Also, what are the benefits for commodity? Inflation hedge, low correlation, and diversification benefits. Return is not an important thing for commodity because over time it's been realized that they don't give as much returns. Also, you invest in physical commodity, the only challenge is storage costs, right? You have a lot of storage costs. So most dominated use is through derivatives. Then the futures price, this is the formula, and it's simply clear: spot price, risk-free rate, because if you want to enter a derivative position, you need to deposit some money because you know you're going to, at maturity, you need to meet up your obligation. So, and also convenience yield is the need for the product now. If it is scarce, the convenience yield is high. If it is not scarce, it has an inverse relationship with inventories. So for this, convenience yield determines when a commodity is in contango or backwardation, the difference between futures price and spot price. If the futures price is higher, so it means this convenience yield is low. If the futures price is lower, it means this convenience yield is high. Raw yield is the difference between futures price and spot price, spot return, collateral yield. Okay, I think those are the key things you need to know there. So let's have some questions, maybe 1 or 2, then we'll move. So change in commodity price are the most dominant here. This one, then this is the most important. Like I told you, returns are not key. This is a raw yield. So yeah, I can see some questions. Yeah, good. So I'll share the slide so you can figure out this. So when the convenience yield is low, it's more of a contango. Okay, so timberland and farmland, what you need to know here, it's timberland and farmland are now natural resources. They used to be in real estate, but I think because of how the level of interest from investors on investing in these particular sectors, they've now been given a niche of themselves, and they're called natural resources. So they give you income and capital gains. You have a timber, you get income from selling the lumber, and also you sell the land to get a capital appreciation. So they have low correlation. This is one of their most important features. So they give you diversification benefits. Their inflation here because of the price of the lumber. biological growth, price of lumber. It has an option value, flexibility of harvest. If prices of lumber are down, you can decide not to harvest. And the most important and new feature is now the ESG benefits. This same, but you cannot delay harvest here. That's just the difference. So for real estate, you need to know the type of real estate and how they are classified. The most important is for you to know that the most dominant classification is commercial and real estate. And it can be debt or equity, it could be public or private. There's a very nice structure in the curriculum. You look at it, it's clear. So here, you need to look at these indices. The indices are just appraisal, repeat sales, and REITs. Appraisal index, because they do valuations. They do valuations at intervals. Therefore, they don't follow the market. So they are understating the risk. Repeat sales index also have a sample selection bias because you're only looking at properties that have been sold just twice, at least twice. That's the properties you are considering. So there are properties that might not have been sold twice. So it means your sample is not representing the entire real estate investment space. So REIT index is similar to common equities. REIT is an exception because this is what it is, liquid. Real estate is illiquid. I'll send you the slide, you can read up this for you. So let's see if we can have one or two. Yes, good. The first one is liquidity. The second one, let's go for the second one. Good, guys, you're doing well. Okay, the second one is A. The second one is A, and this is the reason. If you do for real estate, you're using appraisal, you have January here, you have March here. You just take the price here and the price here. A lot of things must have happened here, but you just smooth it like this. So that's why it's called smoothing, right? So the third one is also sales comparable approach because you have the house you're living in, you don't take rent income, so you can use an income approach. Cost approach is when you don't have a similar property. Okay, so infrastructure. These are real assets. That's what you need to know. They are really, really real assets. They are also supposed to be done by governments, but because there's a lot of things for government to finance, private investors are now going to it. So the benefit is gives an income stream, inflation hedge. Thank you, Yemi. Long-lived assets to match long-term liabilities. So what you just need to know from this infrastructure is try to understand their category. You have economic and social. That's from the need basis, from what they're used. So economic infrastructures are things that give you income, transport, ICT, utility, and energy. While social are those things that are expected to be done by government as welfare to the people, educational, healthcare. And then the stage is also important. You have brownfield and greenfield. Brownfield is an existing structure. It gives you less risk, more cash flow, but less potential for growth. While greenfield gives you high potential for growth, more risky, more uncertain, and also higher yield. Lower yield for now, but in the future you get more growth. So it could also be direct. You can invest in infrastructure direct, or you go through ETFs and REITs. The risk here is regulatory risk, just like if you look at the like Lagos now, you have these toll gates. If the next government comes and say we don't need toll gates, it becomes a regulatory risk. Financial leverage, you have to borrow because it's highly costly to engage in infrastructure. Construction risks, the possibility that it might not eventually get constructed. Operational risks, maintaining the facility. Currency risks if you're investing internationally and all that. So these are the risks you have. Can we attempt these questions? Okay, the first one is a greenfield investment, I think. The other one, social infrastructure assets include, okay, healthcare facility, yes. Yes, infrastructure gives you an inflation hedge. I think I've said it somewhere, yeah, inflation hedge, okay. So The next things are others, collectibles, tangibles, fine arts, and all that. What are their benefits? They give you current income. They give you some source of enjoyment when you have them. Risks, they can fluctuate dramatically. They are highly illiquid. You need to also know how to carry out an auction expertise because most of them are sold via an auction. Risk management, I've talked about this more. Standard deviation is not the best way to invest in and to measure the risks of alternative investment. Rather, use a Sortino ratio. And also, if you're doing derivatives, you are exposed to operational risks, counterparty risks, and liquidity risks. So I think that's all for me. I just want to use this media. I know I might be a little bit fast at the end because of time, just trying to touch on most of the things that I have on the screen. But it's been nice being with you guys. It's been fruitful. The participation has been wonderful. I wish you the very best. I like the earlier facilitator said, I don't hope to see you in the next boot camp. Wish you all the best, and it's always my pleasure to see how we can also support you in acing the exams. Wish you all the best. You've made a good decision in joining the CFA program, and you'll be better for it. Thank you.
Thank you so much, Muhammad Buba, for very, very instructive alternative investment lecture. At this point, I have the pleasure of welcoming the chair of membership committee for CFA Society Nigeria, Segun Jimoh, who will be handling the next session, which is equity. Segun.
All right, Yemi, thank you. I think it's not in heaven yet. Can we give the candidate like 3 minutes break so they can stretch their legs or things? Yeah, you guys can just to break.
I think
maximum 5.
I think while they are on a very short break, I can pass this information across that we're mulling the idea of having real-time feedback from the candidates. Maybe after tomorrow's session with level 2, they can dial back, but I'll have to have more engagement with my colleagues in the society office to actually determine that further. Then we shall be communicating to candidates decisions with regards to that. We would like to engage with you to know how best the society can support candidates and get feedback from you as to what can be done better and how we can proceed, just to make your journey to earning this CFA charter better and smoother. Thank you. While we wait for Segun, maybe we can share some of our videos with you. Thank you.
Let me know. Can you see my screen? Or not?
Not yet.
Oh. How about now?
Yes, it's showing.
Thank you, Gloria. So, just for you guys just to take a water break, then we will start at 11:02. Oh yeah, please can you check the chat? The chat. Someone is asking if you have a study group, which I think let me mention this morning. You can put it there, yeah.
Sure, Shagun, sure. I'm going to drop it in the group chat. We actually have a forum on our website for all levels. So that's the direct link to the forum for level 1 candidates. So feel free to engage there with each other. And if there are any inquiries, you can also drop it there because our moderators will be looking at it to respond to any inquiries that comes up.
Thank you, Gloria, for that. So guys, so we are starting with, we are moving to another one, equity. So good morning once again. We are, I'll be taking you guys on equity. The purpose of this is just to give you guys a guide on the key topics in equity, quickly do like a brainstorming, a revision on those topics, and we can do a Q&A. Hopefully we will have a time. This is for 2 hours, and I believe we should be able to cover as much as we can. All right, so let's move on. Now, the first thing you need to understand when you are doing CFA is that you need to understand your weighting. Each course, they have their weighting in the curriculum, right? And all these 10 papers that you have, the FRA, equity, fixed income, they are grouped into what we call 4 functional areas. The first thing you will see in the exam, but that is what you should usually say at the number 1 is your ethics and profession. So now, the syllabus is now structured in such a way that the morning session will be different from the afternoon session. In the past, it used to be the same. You see all the 10 papers in the morning, then you see the other 10 papers in the afternoon as well. But now they have been divided into 4 functional areas. The first one is equity and professional standard. The other one is tools. Under your tools, you will have quantitative method, you have economics, and you have financial reporting. That is FSC, financial statement analysis. That is what it's called now. All right, so the next one, which would likely be your afternoon, I don't know how the examiner would structure it. They might bring the last 2 as your morning session, bring the next 2 as your afternoon. It depends. It's at their prerogative, right? So the next functional area is portfolio management and analysis, which we have in corporate finance and portfolio management. And the last one is your assets. Your assets, we have equity, to have your fixed income, to have your derivative, to have your alternative investment. So if you see the FRA, the ethics, the equity, the fixed income, and the corporate finance, this make up your 62%, while your economics and quant make up your 20%. That means that these 6 courses, they're about 82. Now, this 82%, which of the functional areas are they into? They are mainly into your ethics and professional, your tools, yeah, and your assets. So you see that your equity is in your assets, your corporate finance is in your portfolio management and analysis. So it means that all these 4 functional areas, the examiner structure it in the extent that the key topics will still be in some of the functional areas. So you don't have a choice than to be prepared. Unlike before, I can say derivatives, I'm not that strong in it. I can do this, it has a lower weighting, but it's merged with assets where you have equity. It's not as if you are going to be marked as per functional area. You will still be graded based on the courses, right? But it's just that you will not see the examiners. Number 1 to 5 is equity. Number 6 to 7 is this. It will be mixed. You might see number 1 as equity, then number 2 will be derivative, and number 3 will be fixed income. So it means that you need as much as you can to be able to understand all these things. So you can switch and say that, oh, this question is actually for equity, this one is actually for fixed income. Now, onto the equity investment, your equity for level 1 is structured into 2 areas. You have the equity investment 1, which has 3 topics, which are your market organization and structure, your security market indexes, your market efficiency. And number two, you have overview of equity, you have introduction to industry and company analysis, and you have the equity valuation and basic tools. So let's quickly run through these 6 topics, and we can take some Q&A session after that. So the first one, let's look at your overall equity security. What are the things I need to take away here? The key takeaways from here is that you need to understand what are common shares. These are the ordinary shareholders. They have a residual ownership of the company. You have to understand who are the preference shareholders. The preference shareholders, the difference between them and the common equity holders is just that their shares behave like, or their holdings behave more like, it has a debt characteristics as well as equity characteristics. What does that mean? It means that number one, they have a predetermined interest, which is fixed, and they get that at every set date. So they are like debt in the sense that they get their interest irrespective of what happened. Now, they behave like equity or shares because you can hold that preference shares to perpetuity. That is, you can hold it for life. Just like equity too, which you can hold for life, yeah? So, and preference shares, they don't share in the operating performance of the company, they don't. You pay dividend from the net assets. So upon liquidation, the preference shareholders are ranked before the common shareholders. So the common shareholders, they are your regular ordinary shareholders. They have the residual ownership of the company. They participate in the governance process of the company. Another thing, a takeaway here is that you need to understand the voting. The voting can be by proxy, in the sense that somebody can vote on behalf of the shareholder. It can also be by statutory, that is one share, one vote, but it can be cumulative. Cumulative in the sense that instead of having one share, one vote, if you are voting on like multiple issues, you can cumulate all your voting on those 3 issues and vote for just only one. So the benefit of this is that it allows the minority holders to also have a say in the company. So that is the takeaway. That is what the examiner expects you to understand, it, to be able to distinguish between common shareholders and preferred shareholders. You should expect a question there. So another thing you should understand is the difference between private and public equity securities. The private are your private equity investment, are your VC, your venture capitalists, which normally provide seed capital, startup capital. They are there at the early financing. They are there at the embryonic stage when the company is just starting, right? Hold on, I can see someone saying that the volume is low. The volume is high from my hand, yeah? How about now? I would want to believe that the volume is okay now. Is it fine now?
Yes, it's a bit louder now compared to before.
Okay, I've increased the volume. All right, so can you guys still see my screen, yeah? My screen is still there, it's still visible, right? Okay. All right.
Yes.
So, as I was saying, the VC, your venture capital, they are usually there at the beginning, at the embryonic stage. You also have what we call leverage buyout. These are your MBOs and your LBOs. Your MBOs are management buyout. The management buyout is when the management of the company or of that subsidiary, they are buying that subsidiary from this parent company. And you have a leverage buyout too, when a group of investors come together through the use of debt and they buy a company. Yeah? And in fact, most times they take it private from being a public company. And you also have your PIPE, which is private investment in public equity. This one is just when you have a public company and a private investment is made in that public company, and that shares is not listed. It can be like a cross holdings. Maybe GT Bank try to buy shares of Zen Bank in a private placement arrangement, and that is not, those shares are not traded here. So you should also understand that the public equity investment, they have some particular characteristics, which are one, the focus on short-term performance as compared with private. You spend a lot of money to be able to list your equity on the exchange, unlike private. The cost of investment relation in the public company is higher as compared with private. However, opportunity to raise capital is high in the public company as compared with private. Also, for a public company, the public scrutiny is higher as compared with private company. And the corporate governance for a public company is solid. It's more robust as compared with private company. That is what that is major takeaways from this topic. So another thing you can understand is that how do you invest in equity? You can either invest domestically or invest internationally. Your domestic is just you getting the exchange. Like now, if you want to buy shares in Nigeria now, you can go to any of your stockbroker, buy the shares. However, if you want to invest in shares that is not listed on Nigerian Stock Exchange, it's not in your domain. Like now, you want to invest in shares listed on London Stock Exchange, New York Stock Exchange. How do you go about it? What we are saying is that you can either do what we call a direct investing. I.e., you go to London, you get a stockbroker, you go to US, you buy directly. But how many people can get that kind of direct investment? Because in some countries, there are usually controls in place to avoid foreign companies taking over their domestic companies, yeah? Or they don't want a volatility in their currency. You know, if foreign investors are so much, they are the ones that control your equity market, they can decide to do a sell-off. And when they sell, they want to repatriate their cash. At that point, the law of demand and supply can come in and can make your currency, your own currency, to depreciate, yeah? However, if you cannot get around with the direct investment, there are other vehicles that you can use for indirect investing. This, as per your level one, this indirect investing are mainly what we call depository receipts. They are DRs. Let me just give you an example of it. However you want to define your DR, this is the basic. The basic is that I go to US, for example, I buy the shares of maybe 10 companies there. I come to Nigeria. I put all these 10 shares in a basket. I calculate the NAV, and investors will start buying into that basket. In that case, when the dividend of those shares are paid, it's being paid into the basket. When the shares are sold, the money goes to the basket, and these monies are shared to the investors. So invariably, indirectly, you have invested in those shares that are listed on New York Stock Exchange. These are usually facilitated by financial institutions, e.g. banks. I want to believe one or two banks tried to do that in Nigeria in the past. So this depository receipt, it cannot be sponsored or unsponsored. Sponsored means that the companies that own those shares, they're actually aware of that arrangement. So in that case, the investors, they will be treated like ordinary shares. They will have like a voting right. But if it's unsponsored, it means that the companies, they are not aware of it. That means that the investors that are buying into that basket, they don't have a voting right. So the voting right still resides with that financial institution that is trying to organize it. So as long as you can understand that structure, that's the basics of DRs. However, you want to now categorize it, whether global means that you're buying shares globally. Whether American means that you're only buying shares that are listed on New York Stock Exchange. Whether global registered, whether basket of listed, they are all structured that way. It's just that the definition is what? Different. All right, in that case, that first topic is gone. If you have any question, if you think you need any further clarification, just drop that chat. I'm looking at the chat as well. So another thing you should understand is the risk and return of equity. The major returns on equity are dividend, price, and currency. Your currency will only come into play when you are investing in another country. That is, your home currency is different from the currency of the investment. So I think we've discussed the common and preference shares. Another one is that we have, so you can drop a chart for me there. From what we've explained so far, common shares and preference shares, which one do you think is riskier? Is it preference or common? Is it preference or common? Which one do you think? All right, because they have a residual risk. Thank you, Faith. Yeah, I like that. Yeah, that's fine. So someone said I should explain the DR again. Because of time, I'll just quickly do what I'm saying about DR is this. Company. Let's do, let's say CFA society. We are not into business, please. CFA society, we go to New York Stock Exchange. We buy like first 10 company listed on New York Stock Exchange. Let's say we buy 10. 10 times 10, that will give us 100. We bring that shares, 100 shares into Nigeria. We calculate their total value and we calculate their NAV, the next asset value. Then you, as an investor, you're not buying into that basket. So as you are buying, it means that you have bought a depository receipt from us, meaning that you have indirectly invested into those 10 companies. So the dividend, the price returns, you will get it. All right, so another thing is cumulative and non-cumulative. For a preference shares, it can be cumulative or non-cumulative. Cumulative means that if you're unable to pay their interest this year, next year, before we pay the ordinary shareholder dividend, you must pay them what was not paid last year. Non-cumulative means that it is not. Non-cumulative means that it is not cumulative. That is, if you don't pay your last year, it means that next year we don't need to, first of all, pay you before we pay the ordinary dividend order. Now, tell me, between cumulative and non-cumulative, which one do you think will be riskier between cumulative and non-cumulative? Which one would you rather invest in that will give you a peace of mind if you don't like taking risk? Okay, yeah, non-cumulative is actually riskier because cumulative, if you don't pay me this year, you still pay me next year before you pay any other person, right? So that's part of the quiz that you should, yeah, okay. Okay, I've sat, but I'm shouting here, yeah? All right, so somebody said currency return. So this is the point. The currency return is just telling you that you're having more returns from your holdings from the exchange rate. Let's say you bought 1,000 shares, or you bought $1,000 of shares last year. When you were exchanging that, or when you were buying that dollars, you bought it for 500. Today, let's assume dollar is now 690. When you sell that shares at $1,000 again today, if you're exchanging it to Naira, you'll be getting 690. That means additional 190 per dollar. That's the currency return for it. That means that you are getting more Naira as compared with when you bought that. So that is currency returns. So you can also use equity and company value, right? So how do you think management increase equity value? Majorly, it is through performance. They have to perform. So if you see a balance sheet of a company, you'll see the equity value there. The equity value is simply a representation of the past performance. If you see a company balance sheet, What equity value that you are seeing there, it's just telling you a representation of past performance. Because when you see the equity value, you remember that you see what we call retained earnings there is there. So that is what is there. However, your valuation that you are doing for level one, whether you are using dividend growth model, you're using your CAPM, whatever valuation techniques that you are choosing, you are basically saying what the future prospect of the company will be from your perspective. So your valuation is an indication of the future prospect of the company, while the valuation that you see in the books are a representation of what? Past performance. That is just the basic distinction between the book value of equity and market value of equity. And the equity capital can be used to finance assets, you can use it to finance so many things. All right, so another thing, let's quickly move to industry analysis. Before you invest in a share, or before you invest in a company, you need to analyze the company. Analyzing the company means that you need to do some research to see whether that company is worth investing or not. Yeah. So in that case, before you can do that, you also, the first thing you need to do is to understand the industry that the company is playing in. Yeah. You need to understand whether the industry is profitable. So by then, you now do what we call a company analysis to analyze the company itself. So if you analyze the macro, then you go down to the micro, and you go down to the company analysis. That is what we call top-down approach. But if you start from the company to the micro and to the macro, that's what we call bottom-up approach. So why do you need this analysis? Just like I've said, it will help you to understand the company. It will help you to understand the industry. It will help you to understand the environment. As a credit analyst or as an investor, it will help you to understand or to see whether it's a viable company or not. Now, for industry, we need to have a categorization. You need to know that this company is into software, this company is into medicals, etc. To be able to do that, yeah, you need to get what we call industry classification. There are two broad types of industry classification that you can have. The first one is the government owned, and the other one is the private owned. The reason is just that the commercial ones, they are updated frequently, while the government owned are less updated frequently. Most of the government, they don't identify individual firms, so you might not know the exact composition, but the commercial providers, they identify the constituents of firms. Government do not distinguish between what is called small or large firm, profit or not for profit. However, private does. So, because if you want to analyze industry, you need to understand, you also need to understand whether the industry is cyclical or non-cyclical, whether the industry is defensive or non-defensive. Cyclical means that their earnings fluctuate with the business environment, while non-cyclical means that it does not. However, the cycle is, their earnings will remain stable. So you need to be able to identify this, because your investors that you want to advise, or you as an investor as well, you need to be able to see whether you actually need, that is the kind of industry or company that you want to put in your portfolio. All right, so there are two major models that you can use to do what we call industry analysis. The first one is what we call Porter's 5 forces. That Porter's 5 forces is just for you to use 5 criteria to be able to define whether that industry is profitable or to analyze whether it is profitable or not. These 5 are rivalry among the existing competitor, threat of entrance, threat of substitute, power of buyers, and power of sellers. Yeah. So some of the key things that you need to note is this. If the rivalry among the existing competitors is high. If it is high, it means that there will be what we call price war. Price war means that everybody will be lowering their prices so as to get the clients. If I lower my price so as to make sales, it means that my margin has dropped. Because except you have a way of cutting your cost to still maintain the margin, which is not really visible most times. Yeah, so what will make you to understand whether that rival among a competitor is high is that look at the number of competitors, look at the diversity, look at the concentration. Or say the audio is not so good. I don't understand what's happening to my audio. Okay, how about now? Is it good now? Maybe I should use a speaker. Hold on. Give me some minute. Hold on.
Battery high. Phone 1 connected. PC connected.
Okay, so let's just go on. Someone's saying that it's good at my end. The other one's okay, so that means the next one. So what I'm saying now is that those 5 forces you have to check, because those 5 forces are what will determine whether the industry is profitable or not. So, and another point, some of the point that you need to understand is that check the number of the competitors in rivalry among existing competitors, check the switching cost. Check the switching cost, check the industry growth. Is there still opportunity for growth in that industry? Yeah. If it's a slow growth, it means that there are no opportunity, meaning that the rivalry will be so high. If you cannot get out of that industry, it means that, there'll be a lot of fixed cost that those guys will need to cover, right? Another thing is threat of entrance. Look at the barriers that are in place. If the barriers to entry is so low, that means anybody can enter the industry, because as players are entering the industry, they'll be reducing your margin because they will also want to play, want to sell to make profit. So if the barrier is high, it means that the entrance threat is low. That means that the industry will likely be profitable. Also look at the threat of substitutes as well. The threat of substitute, just look at switching cost. Can people easily switch? What are the buyers' propensity to switch? Check that. And also check the power of buyers. If buyers have so much power, how will you know? Check the number of customers that they have. If a particular company, the customer base or the revenue is controlled by like 10 clients, it means that those 10 clients have high power. Because what the buyers are looking for is the highest quality of product with lowest price. They want to pay very low for very high. You sell and they control the industry revenue. So you can also check the power of suppliers too. Suppliers want to sell to you at a very high rate with low quality. So that means that they will be passing too much cost of but if their power is low, that means that industry will likely be more profitable. Another thing, some key points that you need to understand. Check the barriers of your design. If it is low, it means that the margin in the industry is likely going to be. Look at the concentration of firms too. If 2 firms, I don't know, I think you guys are having something from the area. Is it Yoga? Is my audio clear, very clear from your end? How about now, guys? How about now? Is it okay now? microphone is breaking. Hello? Can you guys hear me properly now? This one is not helping. This.
Battery high. Phone 1 connected. PC connected. Power off.
Hello? How about now? Is it breaking now or not? Is it clear now? Yeah, I've already switched off the speaker. How about now? Switch. Let's work. Hello, how about now? Can you guys hear me clearly now? Is it better now? Ah, it's better now, very clear now. All right, that's good. All right, that's cool. Okay. All right, so we are at the Potter's 5 courses, right? So another thing I was saying was concentration of firms. If the industry is controlled by maybe large 2 firms and they own like almost equity, almost equal market share, the industry will be so, the competitiveness of the industry will be high. But if there are many myriads of participants, the competitiveness might not be as high as 2 controlling giants, because if one has 50, the other one has 50, they'll just be competing among themselves. It will be a huge price war. Another thing you need to understand is what we call unused capacity. Let me just give you an example. During the downtown, when we have the peak of COVID, there was a lot of contracts that were put on hold, let's say for oil and gas industry. Some of the tools that have been bought at that time, they were as high as $10 million, $11 million, new tools that they wanted to be used, or they are prepared, they were invented to be used for 2020 operations because things were going up. the industry is booming, right? However, COVID came, and you know that you will have to continue to get what we call your depreciation. Whatever the case is, your depreciation will still be there. There is no fun, no. So the depreciation will still be there. All these things will still be there. So because you want to cover that depreciation and some, what is it called? Some buildings, the lease and rent that you have, you might likely want to cut down your cost to be able to cover those fixed costs. So that will now make you to drop your price, to even be engaged in what we call a price war. If you are dropping your price, your margin is eroding. Another one is stability in the market. If the market is stable, that means that the industry is profitable. But if there's volatility in the market, it will likely cause what we call the erosion of the margin. Also, check the customer's price sensitivity. If in the industry, the customers are so sensitive to price, meaning that you will likely want to give them at a cheaper rate, even with higher quality, your margin will likely drop. So that industry is not as profitable as you might think. Also, check the maturity of the industry. Is the industry at the embryonic stage? Is it at the growth stage? Is it at the maturity stage or at the development? So we will still talk about that. But industry that are usually matured, they don't have opportunity for growth. Then the prospect of the industry is likely low. Unlike an industry at the growth stage, that the opportunity for expansion is still huge, the margin will still be what? Higher. All right, so that's that about quotas 5 or 6. I think this network really took our time. The next model that we're going to talk about, industry life cycle, the next model that we're going to talk about under industry analysis is industry life cycle. You want to see where is the stage of that industry? Is the industry at the embryonic stage? What are the characteristics you should watch out for? Are the growth slow? Are they presently having high prices? And they're presently having significant investment coupled with the high risk? That means that that industry is at embryonic stage. Is the industry at the growth stage? You see rapid increase in the demand for their goods. Their profitability will be huge. It will be improving. Their prices will be falling because of economies of scale. At that point, competition will still be lower. However, at that point is when the competition will start coming in. But if the barrier is high, the competitors will not come in at that time as much as they should if the barriers are not there. Then the industry can still maintain profitability to a certain stage. But if there are no barriers, participants, competitors will flood into the market or into that industry and reduce or even erode the margin in the industry. Another thing you need to check out for at the industrial life cycle is the shakeout stage. At that time, their growth is now slowing down gradually because of intense competition. Profitability is what? Declining. Then you get to mature stage where there's little or no growth. In fact, a lot of companies in the industry are just buying each other out. They are trying to consolidate their market share. They might even turn to an oligopoly because there might be few people that can survive. The ones that cannot survive and have sell off their business and exit the industry. At that point, the barriers will start increasing, if not at the highest, because the margin is low and you need huge investment to be able to compete with people that are already consolidated, the companies that are already consolidated in that industry. And you get to a decline stage where you have negative growth, you have excess capacity, you have high competition. So there's something you need to understand here too, is acting your age. The industry or the companies playing in this kind of industry, they need to act their age. So if you see a matured industry, then the companies in that industry should be acting their age. What do we mean? What we mean is that the profit that they have will likely going to be stable at that time, and majority of their earnings should be distributed as what? Dividend. Right? it is not at this point that they will be looking for one venture to invest in. They need to give their earnings back to their investors. But at growth stage, we expect industry at these companies in this industry to still be what? Expanding, right? That is why when they are asking you for value stock and growth stock, this is what they are saying. The value stocks are usually the matured companies, while the growth stock, the industry is still at the growth stage. While the value stock, their stocks are, or the companies or the industry, they're actually at the what? Matured stage. Can somebody just tell me between value stock and growth stock, which one will have high dividend yield? Which one will have a higher dividend yield? And which one will have a higher PE ratio? Which one will have a higher dividend yield between value stock and growth stock? And which one will have a higher PE ratio between the growth stock and value stock? Value stock will have a low PE ratio, correct? And growth stock, what? Just, okay, so give me, number one is between growth and value stock, which one will have a higher dividend yield? Okay, yeah. So that is the reason why we said value stock will have a higher dividend, because most of their earnings, because they don't have any opportunity for growth, most of their earnings are paid out as what? Dividend. At that point, they will have what we call higher dividend yield. However, because growth stocks are still, they still have enough room for expansion, then most of their earnings are still used for what? Expansion. That is why their earnings will be this thing. That's why they will have what we call a higher PE ratio. All right, that's good. I like that. So another thing, when you understand the industry, then you can now do a company analysis. Majorly when you're doing a company analysis, just look at cost leadership. Is the company playing as a cost leader? Just like Swatch versus Rolex. Swatch is trying to sell its product as the lowest cost producer, while Rolex is saying that they're a differentiator. They are selling their product for high quality and for a premium. In fact, when you are talking about differentiator, you can either be a niche player or a general differentiator. A niche player means that your product is of high quality for a particular segment of the market, like Rolex, like Rolls Royce. You know, you can't say, that's why when they are producing in a year, they say that they are only producing 20. So they are differentiator, but in fact, in that strategy, they still are a niche player. A niche player means that they're trying to focus on a particular segment of that market. So when you do company analysis, also check out for the firm overall value. What is their overview? What is their operations, their governance, their strength, their weaknesses? Look at their pricing environment, their product cost, product demand, industry characteristics. Then you can do your financial ratios and compare with other firms or over time. Then you cannot do what we call a projected financial statement. That projected financial statement is now what you cannot base your valuation on. All right, so the next one is about valuation. How do you do equity valuation? What are the things that you need to do for equity valuation? Why are we doing equity valuation? We just want to check what the intrinsic value of a share is. What do we mean by intrinsic value? It's a value that is placed on a security by a knowledgeable investor. So that price, you cannot compare it with what the market is presently pricing it for. If the market is presently pricing it higher than what the knowledgeable investor is placing on it, it means that that shares or that security is overpriced. It's overpriced. So what can I say? I'm trying to use an English, but the point is, if you want to make a conclusion about whether it's overpriced, underpriced, or fairly priced, always look at it from the market perspective. Yeah. If the market is presently buying it more than what we feel should be the fundamental value, that means that it's been overpriced. If they are presently buying it lower than what we believe that the cost or the price should be, meaning that they are underpricing, that is, they are underpaying for it. But if they are paying over, that means they are overpaying for it. That is why that thing was coined overvalued, undervalued, or fairly valued. So if you want to trade or if you want to buy a share, it's based on your conclusion of whether it's overpriced or not. When you are doing your intrinsic value versus your market value, you have to look at the size of the difference. Is it that okay or not? Because the difference that you see now might be eroded within a second, because you are not the only person that is doing it, right? Look at the confidence of your valuation model, the confidence in the estimates input that you have done, the number of analysts that are actually following that security. If so many analysts are following a particular market or security, there's likelihood that that security will be traded at its fundamental value. And look at the length of time that will make the security to revert back to its mean. All right. So what are the equity valuation that you need to know? They're basically into three: your dividend growth model, your discounted cash flow, which is your dividend growth model, and your free cash flow to equity, your multipliers, which is mainly your ratio of your stock to the fundamental, like your PE ratio, your ratio to price enterprise value, and your asset-based method, which is your total asset minus your total liability and preferred stock. All right, so your dividend growth model is basically your formula driven, which is your D1 into KE minus G. Your D1 is your DO into 1 plus growth. Please note, if the examiner should say that dividend as at today, that means that your dividends are at year 0. But if you are doing valuation, your valuation should be based on dividend in future. Remember, like I said, your valuation is based on the future prospect, the perceived, let me put it that way, the perceived future prospect of the company. So if you want to perceive based on the future prospect, then you must be doing the future, not now. But if the examiner has said that dividend next year is this, then you don't need to include growth in your numerator. Remember, your returns on equity is basically your dividend, your price returns, and your currency returns if available. Now, another thing that can help you in valuation is this. The reason for valuation, or the basic meaning of valuation, is that you are saying that all the future earnings, the future benefits pertaining to this security, you are discounting it to present value. That is what your valuation is just doing, right? If you are saying, I'm just saying that the price that I'm giving now is the present value of the future income that I will get on these shares or on this security. Just like if you go and buy a share of GTB now, today, what you are basically saying is that you are paying that 50 naira or 20 naira to have access to the future benefit of that shares. That's all. And that's the basis of the valuation. All right. So dividend growth model, it assumes that dividend is an appropriate measure of shareholders' wealth. It assumes that there will be constant dividend growth rates all through. Those are part of the assumption, and that is one of the okay. When you use G in the numerator, and I see that somebody is also asking whether D1 is for future or not. When you use G in the numerator, it means that the dividend given to you is as at now, as a DO. DO means year 0, as at today. Then you are adding G because you have to add G because whatever you are doing is for the future. You want to discount future benefits to now. But if the examiner say the dividend is for next year, it means that the G has already been added. These are the petty things you need to take cognizance of because it can make or mar your exam. Yeah. All right. So another thing is that the valuation will not make sense if the denominator is, let's say, negative. It doesn't make sense. It means that the KE must be greater than the G for the valuation to make sense. All right. So another one is your free cash flow. Our free cash flow, note this distinction. The free cash flow to equity that you see there is just another representation of defining. I'm just giving you a basic way you can understand it. It's just like another representation of defining what we call dividend. I want to value a share. I can value using dividend growth model because the dividend can be given to me. But if the dividend is not given to you, then the free cash flow to equity might be given to you. In fact, free cash flow to equity is what we call the dividend capacity of the company. That is the capacity as much as what the company can pay out as dividend. So it's another representation of dividend, but with a twist. The twist means that, remember, if the examiner should give you earnings in the question and says that dividend payout is 40%, to get your dividend, all you just need to do is just a 40% multiplied by the earnings. But if the examiner does not give you dividend, the examiner is giving you free cash flow. Then to get that free cash flow, you must use a formula. That formula is you have to look for the net income of the company, add back the depreciation, remove the investment in working capital, remove the investment in fixed asset capital, and also remove the net debt. Your net debt is debt repayment during the year plus new debt that you got during the year. So it's another representation of your dividend. However, with a twist because it has its own formula. So if you are doing the free cash flow as at year 0 today, if you want to use that free cash flow into the same formula of dividend growth, it must be free cash flow to equity into 1 plus G. You must include G in the numerator. But if the examiner gave you, or if you are given the financials of the company for next year, that is a projected financial statement, you don't need to include G in the numerator. All you just need to do is subject the financial information, the projected financial information into the free cash flow formula, get whatever you have for the free cash flow to equity, and divide it by your KE minus G. That's it. Note that, please. And you can also get your free cash flow even from your cash flow. All you just need to do is just do your cash flow from operations minus your free cash flow from investment plus your net borrowings. Why are we only removing fixed capital investment from CFO? Because your CFO has already taken care of your net income. It has already taken care of your depreciation. It has already taken care of your increase in working capital. Remember, when you are calculating your CFO, you will look for increase in inventory, whether it's a use or source of cash. You will look for increase in receivables. Remember, your increase in receivables is a what? Is a use of cash. But if your receivables should reduce, is a source of cash. That means that people have paid you. But payables, if there's an increase in payables, is a source of cash for you. That means that instead of you paying your vendors, you are using their money. But if there's a reduction in payable, then that is a what? A use of cash. So because your CFO has already taken care of all this net income, depreciation, investments in working capital, then the formula has been simplified to only your CFO minus your investment in fixed assets plus your net borrowings. And if the examiner should ask you to calculate your required return on equity, then you can use your CAPM or you can use your dividend growth. All you just need to do is just to rearrange your dividend growth. And if you are calculating non-callable, non-convertible preferred stock, all you just need to do is just put the dividend of that non-callable or preferred stock in the numerator divided by the cost of that non-callable or non-convertible preferred stock. You don't need to put G anywhere. All right. So for your price multiples, you can do it in two ways. Either you calculate it based on fundamentals. Based on your fundamentals, it's just your D1 into divided by E1, that'll be your numerator, divided by KE minus G. Let me ask you guys this. What is the meaning, or let me say, what will be the product of D1 divided by E1? What will be the product? What does that ratio represent? D1 divided by E1. Because at times you need to simplify what you are reading to be able to even understand how the questions will be set or how you are expected to answer or respond to the question set. If I say D1 divided by E1, what does that ratio represent? What does it mean? What does that ratio? Payout. Fantastic. Michael, David. So what I'm saying basically is that in the question, if the examiner is asking you that calculate the value of a share is based on fundamentals, and the examiner just say the payout ratio of this stock is 40%. Don't be looking for numerator again. Don't be looking for D1 divided by E1. The examiner has already given you your numerator. All you just need to do is just put your payout ratio divided by your K, that is your KE, cost of equity, minus G. Then that gives you an answer. That is what we call justified PE ratio. That is what the PE ratio should be based on the fundamentals. Right? So we have what we call leading PE ratio and lagging. We have leading justified PE ratio and lagging justified PE ratio. The difference in them is just the numerator. The payout ratio divided by your KE minus G. But in the again, you just do your payout into G. Just add G to your numerator divided by KE minus G. I don't expect the examiner to start testing that for you for level 1, but just know that we have what we call leading and lagging. Yeah, your leading, just put your payout that way, but your lagging, just add growth to your numerator. That's all. And your justified PE ratio will increase when you have a higher dividend payout. It will increase when you have a higher growth rate, and it will increase when you have a lower required rate of return. All things being equal. So, so what do we mean by dividend displacement of earnings? What we are saying is that we say that if your dividend is higher, your justified PE ratio will go up. However, if your dividend is higher, you have lower earnings for future investment that can even make your PE ratio to go up. But what they are saying is that there's a lot of theories around there, dividend relevant theory, but just note that even if your dividend should grow, where people are saying that your earnings will drop, for income generating portfolio, they will prefer earnings that are assured compared to investment that you do. So at the point, there will be what we call clientele effect. People that are earnings, income investors, they will invest in your stocks. The ones that are for value, they will adjust and invest in stocks that are value oriented. All right. So that's that. Then you can also use your comparables. You can calculate your PE ratio compared to a benchmark with similar stocks or for historical stuff. So another one is your EV. Your EV is your market value of common share plus preferred stock plus market value of debt minus cash and short-term investment. So how do you use this value? It's just your EV divided by your EBITDA. That's allowed. So the last one is your fair value of asset minus your fair value of liabilities. That's your asset-based model. So in that, we've successfully discussed the 3 valuation models that you have. So also, you need to read the advantages and disadvantages of both dividend growth model, price multiples, and asset base. Just know that dividend is easy, widely accepted. The major disadvantages are just the sensitivity of the input. If the denominator is wrong, the estimate will not make any sense. So it's sensitive to the input. And for price multiples is accepted as well, but it's just that the P ratio that is based on fundamentals, just like dividend growth is sensitive to the input as well. And for asset base, it can give you a floor value. I can't be selling my company on an asset base because you can only do asset base when the company is discontinuing operations. But if I want to sell as a going concern, it cannot be valuing me based on my asset base method. So that's that. Yeah. So the next one is on financial system. So for financial system, what we are saying is that we have to provide a financial system that will encourage both the borrower and the investors to invest. And this will help our financial institutions. And that can help the economy as a whole. So what do we use financial system for? We use it to save money for future. We use to borrow money for current use, raise capital, exchange assets, trade informations. What are the main functions of financial system? So it is for discovery of rates of return that equate savings and aggregate of borrowings. It is good for allocation of capital for best use. And that's why the banks, they'll be asking you for different information if you want to borrow, so that they will know the best person to give money to. So in the financial institution, we have different kind of assets and contracts. You have your financial assets, you have your real estate, you have your public, you have your sports market, you have your primary market, your contract, fixed income. If you go to the financial market now and buy T-bills, what you have simply done is you have taken a contract that I'm borrowing you this money in exchange of this fixed interest payment over so period of time and repayment of my capital. That's what you have done. It's a contract. If you should go to the financial market and buy equity, whether common, preferred, warranty, what you have simply done is you have exchanged your money for an instrument that's supposed to give you a benefit over a period of time. That's what we are saying. But if the market lacks probity, if it lacks the integrity that is needed, people will not invest. And that's why you have the Apex Bank, you have different regulatory body, SEC, everybody, just to regulate and ensure that the transparency, probity, integrity of the market is in place. Yeah, so you can also take mutual funds, ETFs. These are pool investment vehicles, but they are also contracts. You can also take your currency futures, your forward. I was in your class when the Fola was taking you guys the forward, the futures, the option. What you are simply doing, you are taking a contract in the exchange market. So it can also be commodity. And we also have different players in the market. You have your broker, you have your dealer, you have the investment banker, you have your securitizer, you have your arbitrageurs, you have the clearinghouse. This one are just to ensure that you have the both parties, they honor the what agreement. And you have different positions in the market. You have long. The simplest way for you to understand is that long means that you have access to own it. Short means that you have a future contract to sell, you know. So however you want to combine it, anytime you see long, you want to buy. Anytime you see short, it's just to sell. So they might not call it into different short sell position, short to reduce, long, whatever they call it. Just understand the basics. What you need to understand in all these financial markets is, as long as you understand the basics, however the combination is done, default back to your basics and you will get it. And that's it. All right, so like a short sell position is one that stands out in your curriculum. I think this one on your leverage position. Short sell position means that you simultaneously borrow and sell securities through a broker. So I go to a broker now. I said, I want to buy 1 million shares. I want to borrow 1 million shares of GT Bank shares. And the guy said, okay, I have someone that is willing to borrow you. The guy borrowed me the 1 million GT shares. Then I sell it immediately. Yeah. However, I must return that security when the lender requests it or when I close out my short position. But all my proceeds of that 4 million shares, I must keep it with the short seller and with my broker, and my broker will be using it to invest for me. Now, look at that kind of position. Can you just tell me, just give me, why do you think I would want to do that? I'll borrow 1 million shares, I'll sell it now. Anytime the guy asks me, I will go and buy that shares back and give the guy the 4 million shares. Why do you think someone will want to take that risk? What if he's selling to me at 50 naira today and the next month the shares has gone up to 100? Why do you think I would want to take a short position? Why? These are the kind of things you need to probe your mind about that will make you to understand any question. Thank you, God's will. That's the best answer because I've done my analysis and I believe that the shares is currently overpriced. The market is paying so much for these shares. At that 50, I believe that that shares is overpriced. I can go and borrow it. Then I'll sell. I'll be using the money to invest. In 5 months' time, 6 months' time, when the guy comes back to me, I believe that the shares might have dropped to 40. Then I'll go and buy for the guy at 40. I've already made a spread of what? 10 without owning the shares. I did not take the risk of longing on the shares at all or owning the shares, but I make a $10 spread on each shares. But your valuation has to be very top-notch. If not, you will enter what we call basic. All right, so that's that. So the short seller, he get a short to rebate and you get a payment in lieu. So another one is leverage position. Is that I go and borrow money and I use it to purchase an asset. So let's say I go and borrow $1 million from Stanbic and I use it to go and buy First Bank shares. Why do you think I want to do that? Remember, that borrowed fund will have interest that I'll be paying and other things, charges, etc. Why will I go and do that? Because I believe that the stock is currently what? Underpriced. So I believe that by the time I'm selling that shares, the returns I will get from dividend and the price returns will more than compensate for the borrowing cost and other charges. So that's why people think it's kind of a thing. But some people have taken it during the boom in Nigerian stock exchange. They are in the early 2000. In fact, most of them had high blood pressure at that time. I know a company, a broker then, that company is under now. All right, so that's that. So another thing you should understand that when you take a leverage position, it magnifies it. It magnifies both your profits and your loss. It's a magnifier because it's only a percentage of that fund that will be yours, and the returns are usually your own, or the loss are usually your own based on your small percentage in the value of the securities that you have. So it magnifies it. All right, so you also have different orders in the market. Market order means that sell or buy now. Market order, limits order, all for order. You can read out this one. So we also have other market transactions like private placement, shelf, secondary markets, and contract market structure. We have different trading sessions. You have core market, you have continuous trading market. Your market structure can be quote-driven. Quote-driven market are usually for, so we call them dealer market as well. They are majorly for fixed income. They are majorly for fixed income. So we also have other driven markets, which based on trading rules. The trading rules are 1, price parity, non-hidden orders, and earliest arriving orders. Price parity means that they first of all execute orders that have the lowest prices, orders that you don't hide because people can hide their orders, right? And orders that come early. All right, so under that trading rules for your order-driven market, you have what we call uniform pricing. We have discriminatory pricing rule and derivative pricing rule. So call markets, they usually use uniform pricing. That is, all trades are executed at the same price. The market will choose the price that maximizes the total quantity traded. Continuous market, they usually use what we call discriminatory pricing. That is, they use the rule or limit the price of order based on who arrives first. And cross network, they use what we call derivative pricing. Just know this thing. What does derivative mean? It means that something is deriving its value from an underlying. That's all. Something is getting its value from an underlying. That's what it is. And if you check your derivative topics, all the securities that are there, they're actually deriving their value from an underlying. So the cross network is saying that the trading system that matches buyer and seller who are willing to trade us. So they get it from other markets, yeah. So market information. So someone is saying that as you go back to, so this one is just telling you what the margin call price will be. The PO is your price as of today, multiplied by 1 minus initial margin divided by 1 minus maintenance margin. So what this margin call price is saying is that at what point do you think you will receive a margin call? You know, in a position, when you take a position like that, so that the market can ensure that all parties honor their agreement, you first of all deposit what we call a margin. You know, you ask people. So as things are moving, if your money is going down, what they will call you to go and add. So when would they call you? It is when the ratio of your initial margin and maintenance margin multiplied by your price, if it gets to the margin call price, that is at that price that they will call you. So it's just a simple thing. Look at the price of the stock multiplied by the ratio of initial margin and maintenance margin. That's all. All right. So in a well-functioning financial system, investors can easily move money from present to future. Borrowers can easily get their funds too. Hedgers can easily trade away or offset their risk. Traders can easily trade currency as well. And the well-functioning financial system has a complete market that is operationally and informationally efficient. So there is a lot of benefit of well-functioning markets. Savers can fund entrepreneurs. If you save your money in the bank now, because you have the confidence that the bank will keep your money safe and they will give you a decent returns, the bank in return can lend those money to real sectors, entrepreneurs that will give a better, that will pay a better interest. What you have simply done is that indirectly you have funded an entrepreneur. All right, so these benefits are enhanced because transaction costs amongst transaction costs can occur among strangers, widening the opportunity for capital formation and the risk sharing economy. Without market regulation, many problems you can have it. Theft, fraud, insider dealings, etc. So one of the major ways to resolve this is to have what we call self-regulatory organization, where the regulators gives the industry ability to control or to regulate themselves. Yeah. So you need to protect the unsophisticated investors so that they can trust your markets. You need to have a minimum standard of competence. You have to prevent insider dealing etc. So if you fail to address many problems, financial market did not function well, liquidity will decline, firms will shun risky projects, new ideas will go off under, economic growth will be slow. So that means that it is very key for you to protect your market and to ensure that your market is transparent, there's a high level of integrity and probity. Market efficiency, I'll be brief here. What we are saying is that, so what are the takeaways here? What the examiner expects you to know is that 3 forms of market, which are weak form, semi-strong, and strong. Weak form is just saying that the market as it stands, it reflects. So in the current prices that you are seeing now, fully reflect all available security market data is there. And this is past price, volume price is there. Yeah, so investors cannot achieve any positive risk-adjusted returns by using technical analysis. So I'm sure some of you must have been passing some street and you must have seen people that are playing this Baba Jebu, Lotto. You will see that they will put a lot of information on the board while people are looking at it. What they are simply doing is technical analysis. They just want to play bets. So all these things is bets. You want to see whether past information will repeat itself in future. It's technical analysis. But we are saying that if the market is weak form, i.e., all the past prices and volume information have already been reflected in the current price that you are seeing, no matter the technical analysis that you are doing, it will not give you any positive risk-adjusted returns. And semi-strong, we are saying that all the past information are there, plus the currently available information. So any fundamental analysis that you want to do using dividend growth model, free cash flow, it will not give you any positive risk-adjusted returns because the security that you are seeing has already reflected all the information that you think you might have a superior knowledge on. And the last one is semi-strong, which has both the publicly available information, past information, I think you're insider dealing, but this is how you are not encouraged. So we say that no abnormal returns or no market is strong form because there's nothing like people trading on insider information. And that's that. And that's a summary of everything that I've mentioned here. So now, if market is efficient, everything we're saying is efficient. So why do I need to manage a client? I don't need to manage because what they need to do is just simply go to the market and go and buy the shares. Then we are now saying that, now see, your role as a portfolio manager will shift from whether you are doing active or passive, it will shift to more of an advisory role. Yeah, it will shift to more of an advisory. It's not that you want to go and buy it because you can easily buy it. It will shift to more of advisory role, letting clients understand the implication of their actions and the understanding themselves, their risk, appetite, etc. All right, but people are now saying, if you say market is efficient, why do we still see some anomalies? So the proponents of market efficiency said all those anomalies that you are seeing is even as a result of efficiency of the market. Now, if markets are not efficient, you will not see those anomalies. So they are the result of market efficiency. So the anomalies that you can see, they are many. You can see the calendar base, turn of the month effect that is saying that returns will likely be higher on the last day of trading of the month and the first 3 days of trading of the month or days of the week. On average, on Monday, the returns are negative. Why? People are just coming back from weekend. So their heads are not straight or they are not cool yet to see analysis that they want to do. And on Friday, the returns tends to be lower because people are already going from weekend. Holiday effect, people are summer now. So we expect prices to depress. All these are just anomalies that we see. So, all right. So we also have behavioral finance that is saying that investors' behavior can make them not to make an informed decisions. It's not that they don't know, but their emotions, let me put it away. So he called it emotional behavior. It is their behavioral finance, which can be cognitive or emotions. So all these ones, what are the ones that we can see that can make them to have irrational behavior? Is loss aversion. They say that people are usually paid more on horses as compared with game of similar value. Just check. Anytime you lose, maybe you are going on the street and 10,000 fell from your purse, you can't find it. You'll be more pained compared to when somebody now dash you that 10,000. That pain will be more than the joy that you get from the 10,000. So these are part of the emotional biases that we said that it can make people to behave irrationally. Urgent behavior too. They said, oh, standard bank shares is very good now. Everybody start buying it. It's urgent behavior without even doing your thorough research. And also about confidence when you are so confident about your thing that can have that. We also have mental accounting, representation, conservative, and narrow framing. Mental accounting is when you are trying to separate your account or your money into different buckets. When in fact you are the owner of the whole thing. You have 10 naira in Zenith Bank, 20 naira in Citibank. If you want to invest, you say, let me invest in Zenith. I don't want to spend anything in Citibank. But your total asset is just 30. However you spend it, your net asset will still remain the same. So people have that kind of emotional biases too. So representative, when you are looking for information and represent that your emotional information. All right, so we also have security market indexes. Have we done? Do we still have any other one? Let me quickly check. Okay, yeah. So that's the last one. Then I'll take some questions. Yeah. All right, so we have security market indexes. This is the last topic here. I think we've been very efficient. All right, so security market indexes. Just look at security market as a bucket. Yeah. Look at, let's say, S&P 500. It's an index. So security, S&P 500 is an index. What are we saying? Top 500 stocks in New York Stock Exchange. That's it. That's it. Nigerian Stock Exchange Index is an index that is a representation of all the stocks on Nigerian Stock Exchange in a bucket. I just want to invest and mirror that index. If I invest and mirror that index, it means that the return on that index will be the same as my returns. That is it. But the point is, do you understand the indexes? What are they made of? So that is why this topic is there. So your index can be what we call equally weighted index. It can be market value index. It can be price index. Those are the major three ones. Every other one are just subsets of those three key ones. Now, the returns cannot be calculated based on price index. So now, look at this. Returns. I want you to understand the construction of an index different from calculation of returns. Index can be constructed or composed as equal weighted index, price weighted index, or market capitalization index. Yeah, another one can be fundamental weighted index. Another one is float adjusted market capitalization index. Now see, these first three are the key ones. What does float adjusted market capitalization mean? It means that it's still the same as market capitalization index, but based on shares that are available on the stock exchange. What do we mean? Some companies, their shares are not available for trading. Let's take it, Dangote shares. Dangote only sold 50% of its holdings. So when you are doing the index, what we're saying is that look for the completion of that 55% only, because the the remaining 45% is not available to public. It's still privately owned. That is it. And fundamental index is saying use your earnings per share, PE ratio to do the weighting of the index. Yeah. So now these are types of weighting that an index can have, how they can be composed. That is different from when you are calculating returns on an index. The examiner can ask you that, what is the price returns of this index? The examiner is only asking you to calculate return based on changes in value. Based on changes in value alone. That changes in value can either be on price weighting index, equal weighting index, market, etc. But don't be confused. The calculation of returns is different from index weighting. They are different. Now, the examiner can even ask you what is the income return on an index. It's just basically asking you the return of in percentage, what the index has paid as a return divided by the value. The examiner can ask you for what is the total return of that index. That means it's a price returns plus income returns. So I've seen in a question where some people are confused. The examiner is saying, calculate the price return of this price weighted index. It's just telling you that the index is price weighted, yeah, but calculate the price returns for me. So meaning that how you are going to set it up, we will look at it. Of course, the weighting will definitely affect the index returns, of course. So that's why the way at which you will arrange a price weighted index is different from the way you arrange an equally weighted index. I'm just saying that you need to be able to distinguish when you are calculating the types of returns on different types of what? Weighting. All right, so the index providers will also have so many decisions to make, like what is the target market index that they intend to measure? How should the security be included in the index? Which security from the large market should be included? It is how often should we rebalance this index? Because when you rebalance the index, the investors that are mirroring those indexes too, they will have to rebalance. How do you rebalance? You will sell the ones that are no longer there, then you will buy the new ones, right? So those costs can also reduce your what? Your returns. So how do you do price weighted index? It's just the sum of the stock price. And you see sum of stock prices divided by the number of stocks in the index adjusted for split. It's simple, easy to know. However, higher price stocks will have more weights than lower price stock. Equally weighted index is calculated as arithmetic average return of the index stocks. So can you see here in price return, we are using the stock price, but in equally weighted, we are using the return on index stocks for a given time period to be matched by the return on the pursuit of equal number. So what we are doing here is just equally weighted. We look at the number of stocks, we weight them equally. It's also simple. You can match this. Another one is market weighted, which you weight it according to their market capitalization of each stock. But another subset of it is market float, and it's free float, meaning that you only use the securities that are available for public investment. So the disadvantage is that stocks that are possibly overvalued are given disproportionate weight, high weight in the index, while stocks that are possibly undervalued are given disproportionately low weight because the index increases as price and vice versa. Now, having a market index, a market capitalization weighted index is synonymous to having or doing a strategy we call momentum strategy. That is, momentum means that successful stocks are given the greatest weight and poor performing stocks are given underweight. And fundamental weighting index, they use weight based on the fundamentals like earnings, cash flow, dividend, etc. It avoids bias of the market capitalization, but it can overweight firms that with high value based metrics such as book to value ratio or NAC. So I've explained this rebalancing. When we adjust the weight of the security, that means that you have to sell and buy and buy. Reconstitution refers to periodically we are adding or deleting security. So when they add, you will have to buy. When they delete, you will have to sell. When they adjust the weight, maybe they take Dangote stock, it was 20% before, then they adjust it to 10. You will have to sell that Dangote stock to go and buy the new weighted ones. So those are it. So what do you use market index for? It can reflect market sentiment. It can be a benchmark for managers' performance. It measures market returns and risk. It can also measure better risk-adjusted returns. And so we have equity market index, which can be based on broad market index, multi-market index, sector index, style index. Then we have fixed income index. They are created like equity, but because fixed income are not like equity, they are constructed based on type of issuer, collateral, coupons, maturity, etc. So there are issues with construction of fixed income index because there are many. They are broader than stocks, and they're usually quote driven, right? So they have a high turnover. Some fixed income are just for 6 months, 3 months, 1 year. As soon as they mature, you must replace them. So there's a high level of what we call the transaction there. So it's the dealer market, just like I've said, it's quote driven. You frequently trade it. So index providers, they depend on the recent prices from the dealers. It depends on from the dealer. So because of illiquidity of fixed income, the high transaction cost from the rebalancing or the reconstitution, high turnover of the constituent stock is making it difficult and very expensive for fixed income portfolio manager to replicate the fixed income index. So, expect a question there. I don't usually play with that. So we have alternative investment index, which are constructed based on your commodities such as grains, livestock, metals, energy, etc. We also have real estate indexes. We have REITs. I'm sure you must have read this under your alternative investment. And we also have hedge fund index as well. But the point is just that hedge fund can be upward biased. The index can be upward biased because they lack regulation to report performance. So these are the general types of indexes that we have: the Dow Jones, the Nikkei stock, all those ones that we have. What are the constituents of stocks? What are the weightings that they normally use? Some use price, some use market capitalization adjusted of flows, and how often do they rebalance? And that's that. So can we quickly look at some quiz, some questions before we go? Alfred is asking, so what does a high PE ratio or low PE ratio class implies with regards to fundamental analysis? Whether it's high or low, you have to be able to compare it with the market, compare with the industry that the company is actually doing on, and also try to compare it with the market. So when you have a benchmark, that's when you will actually know whether the PE that you have calculated, whether it implies an undervalue of that security as compared with the market or represent of value. But in itself, whether high or low, you might not be able to make a conclusion, but try to define it or try to compare it with a comparable. That's when you know whether that stock is performing well or not. So now, guys, we have some questions here. Let's see how far we can take them in the next 24 minutes. And anybody that's scored the highest, you will have a prize from me. So this is 1 to 4. Can you just answer the 1 to 4 and put it in your name? Then I'll see whether they're asking for what that price stays with me. And I will communicate with the society to send that person that price. So look at 1 to 4, answer it in your name. Then when we move to the next one, you answer it in your name too. Then he will see who scored there. But the highest, we have about 13 here. The highest, if anybody scored 12, also that is when you start getting the prize. Anyways, you cannot be having 13 questions and score 2, and you are the highest and you expect the prize. No. So this is 1 to 4. Answer the 1 to 4 in your name. I'll give you the answer. Then he will see whether anybody will score as high as 12 or not. I'm waiting. The 4 questions should not be more than, so it should be 1 question per minute, right? So the first 4 will be 4 minutes, the next 4 will be for 4 minutes, and so on. So guys, just check the way Ayodeji and Smart has done. Smart, you need to put numbers there. 1, this, 2, this. Just check the way Ayodele has done is. Then you guys should just do it how we. Okay, Michael, I like that. Okay, Alfred, okay. Femi, you need to put all your answers in one text, right? I've seen one to Catherine. Put everything, all of you should just put this 1 to 4 just in one message so that it's easier for me to trace, yeah? Okay. So, 30 seconds more. Okay. Okay. All right. So 1 to 4 is gone. It's gone as at now. I'll send a message here. This is where it stopped. It stopped here. This is the stop here. Anytime you see my message stop, that means that one is. So anybody has not answered. So now, let me give you the answer. Number 1 is C. Number 2 is B. Number 3 is C. Number 4 is A. None of you got 4 over 4. In fact, some people got only 1. Some people got 2. Some got 3. So be marking yourself. Yeah? Number 1, C. Number 2, B. Number 3, C. Number 4, A. So continue to mark yourself, yeah? All right. So I go to the next one now. No, don't worry. I will give some explanation. Okay, so if you want us to do the correction, it's fine. So the number 1 says behavioral bias in which investors tend to avoid losses, but rather seek to realize gain is best described as disposition effect. That is just, see, anytime you have a stock and that stock is actually going down, instead of you to stop loss now, get the money and move on. But one time the stock should go up, you really quickly want to sell and move on. What you have simply done is what we call disposition effect. That is different from loss averse, when you are not, when your feelings on horses or the pain that you have on horses is greater than the joy that you have in in getting the same equal amount of gains. Yeah. So yes, Tommy, the answer that I put there is right. Yeah. 1C, 2B, 3C, 4A. Yes. Gambler's fallacy is just like what we call foreland. Gambler's fallacy is just saying that what happened in past will happen in future. You have an hot hand. You believe that what you have done now will happen in future. You make more gains. It's different from the disposition effect. And the returns from depository receipts. If I should explain all these things, guys, let's finish as much as we can, except if I should explain all of this, we might not get to number 6, and there will be no prizes, yeah? But the return from a depository receipt are least likely. So you need to understand the question to be able to answer it properly. Least, the one that will not affect it at all. No matter the number of the depository, it will not affect the returns. But the exchange rate movement will definitely affect it. When analysts recommend on a particular, or their recommendation on a particular DR, will definitely affect the returns. So you guys also need to understand that in your level 1, you have more of least and most. Least likely, most likely. Most means that comes first. Least that comes last. So which of the following statement is least accurate with respect to fixed income index? Least, compare with equity index, it's easier and less. We've said it just now, is much more expensive. Yes, it's susceptible to high turnover. That is one of the characteristics. The underlying security is illiquid because it's dealer and quote driven. That's one of the characteristics. And which of the following most likely one of the main functions of financial system? I mentioned it during the, it determines the equilibrium interest rate. It cannot ensure that market is informationally efficient. It is the participant that will ensure that the market is. So it's also ensure that all investment players receive funding. No, it doesn't ensure that everybody gets the funds. All right, let's go to number 5 and number 6. I'm hitting 5 and 6. Number 5 and 6, put your answer in the same listing. Are you guys marking yourselves? I hope so. I'm waiting for your answers. Five and 6. Okay. Okay. Can see your answers. I think I will have to put a stop here now. Anyway, there is stop so that it's easier for us to track. So I put a stop here. All right, so number 5 is C. Number 6 is B. All right, so we can quickly look at it. It said an equity analyst follow through industry with the following characteristics. Industry 1, it has few companies with proprietary technology, product with unique features, high switching cost, minimal regulatory influences. Industry 2, a few companies producing relatively similar products, sales vary with disposable income, unemployment level, high capital cost and investment in physical plants, rapid shift in market shares of competing firms, and the minimal regulatory influences. Based on the above information, analysts will most appropriately conclude that compared with the firm in industry 2, those in industry 1 will potentially have what? Because they have proprietary technologies, they have unique features, the high switching cost, that is, you can't easily switch. That means you are stuck with them. And there's minimal regulatory influences. They are likely going to have large economic profits. It is that, but people that are selling same products and it varies with disposable income, it means that if my income is low or if I'm being fired today, I will not buy that product again. I'll just move on. So it means that the income or the earnings or the profitability of that industry varies with the macroeconomic condition. All right, the number 6 say for a US investor, which of the following statements concerning investing in depository receipt least accurate? Least accurate. Investing in DRs will provide arbitrary opportunities and maintain currency risk, yes, because investors in non-sponsored DR will have the same voting right as the director of the business. Remember, we mentioned sponsored and what? Unsponsored. Or sponsored don't have voting rights. All right, so let's move to the next one. 7 to 9. 7 to 9. You have 4 minutes there. Or let's say 5, because there's a calculation in number 9. Then I can make stop there. Seven to 9. 7 to 9. Seven to 9. Put all your answers in one message. If the answer is coming. Okay, I think we can stop here. Let's stop. Let me put a stop there. We're going to stop there. All right, so number 7 is C. Number 8 is A. Number 9 is B. So 7 is saying that an industry expressing intense competitive rivalry among people is best described as customer bases their largely on price, a small number of competitors low on this. Number 7, C, 8, A, 9, B. That's it. So if you're expressing rivalry among, well, differentiated product and low exit barrier, if you have a differentiated product and low exit barrier, that is, companies can exit the industry and products are differentiated, that cannot give rise to high value. It's when you cannot leave, that you just have to play in the industry. A small number of competitors and low fixed cost, that cannot give rise to high value. But if the customers are basing their purchasing decision largely on price, of course, you'll be having a price war. Which of the following is most likely to stay with the secondary capital market, which is very obvious, it's a continuous trading. The secondary market are like a continuous trading, your auction, etc. And number 9 is just your calculation. Current dividend is your DU, historical dividend, expected dividend growth rate for the next 3 years, expected stock value at the end of 3 years, investor required returns is this, estimate is this. So you just need to subject the current dividend to 8 years and put the stock price at 33 for third year, then discount them at 15%, then you get the answer there. All right, we have 3 more minutes. I don't know if we can still go to 10 because 10 is huge, 10, 11 is huge. So can you guys give me what you score? Let me see, we will audit it. Let's see out of the 9, who score what? What are these things that you have? You can give us your scores there. 6/9, Alfred, that's like 2/3, okay? So guys, as you are punching your overall listing, I will advise you guys, I want to be sure that you guys are fully ready now. You guys have done your revision as well, but I will advise you to go to the ecosystem more, try to solve as many questions as you can, because it's not as if you have not read, it's not as if you might not understand the syllabus or your mastery of the syllabus might not be solid, but the point is the way the questions are set might be confusing at times. When you see least likely, most likely, you know, that English, the way it's been twisted, it might be confusing. So I will advise that you guys should go to the ecosystem more, solve as many questions as you can, If you have any issues, the platform is there. Raise the questions in the platform. And if we see that as a society, if we see that number 5 is C, and as a society, if we see that you require some level of intervention in any particular course, we will look for one of our facilitators that is in charge of that course. That guy can take you maybe like 5 minutes, 10 minutes, 30 minutes to clear up whatever you might, or whatever your confusion might be. Yeah, so please, but the point is, you cannot get confused if you don't solve questions. You cannot get confused if you don't read. The first point of call is for you to read and solve questions. That's when you get confused, and that's when you seek clarity. So please try to solve more. And like I said, from all the marks that you guys have sent to me, it's encouraging. So I hope and I pray that you guys will have a good exam. I pray for Godspeed, and I pray that in the next boot camp, like I said in the morning, I'll be seeing you guys in the level 2 boot camp. Also, tomorrow by 2:30, we will organize a session for 30 minutes just to get you guys feedback. How best do you think we should organize this more? Or what are your suggestions? Do you want us to improve on some certain thing? What do you want? Do you want us to set you a mock? You know, just come up with your suggestion. The link will be shared with you guys, and it will just be for 30 minutes by 2:30 tomorrow. So come, because it will be beneficial for both the society and you guys. Because whatever you give us as a feedback now will help us to improve more, and it will help you in your level 2. So whatever you do now is actually for your own benefit. So good afternoon again, and I wish you all the best. I wish you luck, and see you in level 2. God bless you. Thank you.
Thank you very much, Shegun. As usual, it's essentially delivered. Gloria, anything for us?
Hi, good afternoon, everyone. So we'll be taking a 1-hour break to reconvene at 2 p.m. for the next class, which would be economics for 2 hours. Then we'd have after economics, we'll have fixed income for another 2 hours. But we are not going to disconnect the Zoom call. It's going to stay on. So feel free to just stay on the call if you want. But once it's 2 o'clock, we are going to prompt you to reconvene. So we start. Thank you for staying with us so far.
Thank you, Gloria. So you guys can use the opportunity of the 1 hour hiatus to network in the chat box. Just get some refreshment, and we'll see you at 2 o'clock.
We are professionals. We are impact driven. We are CFA Society Nigeria, a member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holder's commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietyng.org for more details. CFA Society Nigeria, making finance a force for good.
New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.
Hello, are you looking for a CFA preparatory school? A tuition to help with your pursuit of the highly prestigious CFA charter? If yes, then First Quartile Professionals is perfect for you. You can join us from any part of the world. We offer online and physical classes. Our pass rate have been higher than the global pass rate in all but one of the last 18 run of classes we have had over the years. At First Quartile, we also adopt a mentoring system to guide candidates through their journey to earn the CFA charter. At First Quartile you get a chance to network with many industry experts. Visit our website or call 0817-607-4526 for further inquiries.
Pure Factor Learning Center is a CFA tuition provider in Lagos, Nigeria. We have a wide range of resources that support you to pass your exams. We have a team of qualified tutors with extensive experience in teaching CFA. The main focus at our lecture center is to provide you with the necessary support to make sure you attain your goal. Our unique features include a conducive learning environment, uninterrupted power supply, highly experienced lecturers, easy accessibility, and spacious parking facilities. We offer 2 prep classes, in-person classes and online live classes. For our in-person classes, lectures are solely on weekends. You have 24/7 access to all our tutors. All classes are completed a month to your exams. For our online classes, you have access to our live classes, 24/7 access to our tutors, and access to our online learning management system with recorded videos. Pure Factor Learning. Come to us today and let us make your dreams a reality.